not exactly sure. Is this a prompt for me to take the welcome remarks?
Yes, please.
Thank you very much. Thank you. My name is Frank Ibugu. I am the publisher of BusinessDay. What a delight this morning to be joined by all of you, our distinguished keynote speakers, our guest speaker, our panelists, our moderators, and senior executives, dear ladies and gentlemen. It gives me great pleasure to welcome you to the 13th annual edition of the BusinessDay CEO Forum, Nigeria. For good reason, the CEO Forum sits at the summit of BusinessDay's annual events and thought leadership calendar. This is because the annual convenings address the concerns of C-level executives, regardless of their industry or sector, geographical presence, size, and number of years in operation. The issues discussed here cut across their short, mid, and long-term preoccupations, and they help to shape the challenges of sustainability which we all grapple with. These make the CEO Forum distinct from all other events on our calendar. The theme for this year's CEO Forum is Reboot, Regaining Strategic Flexibility in the Age of Uncertainty. It speaks directly to the problem solving when companies find themselves bogged down by past choices and radically different realities or outcomes. As you all know, companies have to make projections about the future to help them determine where to invest, who to hire, those to partner with, and how to position in the marketplace. When these guesses turn out to be right, the payoffs can be quite huge, but they can also turn out to be wrong. This is very costly, or can be very costly for companies as they try to retrace their steps and then play catch up with competitors. We all agree that uncertainty, agitation, and anxiety define the age in which we live today. In the midst of pressures, conflicting signals, and poor visibility, CEOs are expected to navigate their companies to safe harbor. The problem is that too many decision makers are using old methods that clearly are defied by new challenges. We should all know that there is a time when we necessarily must change. Organizationally and culturally, there is plenty to change in the way companies are run. Cases like this will form the centerpiece of our deliberations today. And our deliberation will be within the context of a still ravaging global pandemic that has more than upended the projections and expectations of companies small and large around the world. We have had first, second, and even third waves of the pandemic, and the uncertainty that it brings is still challenging CEOs and other business managers, requiring them to be sharper in how they anticipate the futures and to be agile in what they have to do about them. It is an age of resilience. It is in this light that I am extremely grateful that we are being joined this morning by two great guest speakers, strategists, and authors. Firstly, include, of course, Dr. Michael Raynor, who has a doctorate from Harvard Business School. I am a proud owner of his groundbreaking book, The Strategy Paradox: Why Committing to Success Leads to Failure and What to Do About It. I think I was fortunate in my very first participation at the World Economic Forum in Davos many years ago to have been handed a copy of that book. Reading parts of the book in the last week as I have to prepare for this, and as I have done in many times over the years, I am even more convinced that Strategy Paradox was written for a time like this. Dr. Raynor is also author of 3 Rules How Exceptional Companies Think, and co-author with Clayton Christensen of the best-selling The Innovator's Solution. We are also joined this morning and we'll be listening to a great speaker, Dr. Jane Mitchell Paul, founder of the London-based Acheron Capital Hedge Fund, distinguished professor and author of the great book, The Economics of Discontent, which talks about how the world got to the brink of how the social contract that has underpinned the social growth, social stability, and economic growth since World War II, and how to move away from the win-lose policies of the recent decades. For members of the audience and who are subscribers to BusinessDay, we make a pledge to arrange to make copies of these books available to you after this CEO forum. This morning, let me congratulate all our CEOs who are leading the organizations to overcoming the strangulating impact of the COVID pandemic, and to say that their resilience today forms a great part of the pillar that holds the Nigerian economy today, and of course, the hopes of millions of Nigerians. Today, we will have 3 discussion panels. The first panel is titled Changing Business for a Changing World. The second panel is headlined New Perspective for Corporate Strategy, while the final panel is titled Our People, Our Future. I must at this time say a big thank you to our sponsors, without whom BusinessDay events would not be possible. I salute in particular MasterCard, MTN Nigeria PLC, commercial partners, and Eat and Go for their generous partnership and support to making this year's event a success. I'm sure that you will agree with me that we have a stellar lineup of speakers gathered at this year's CEO Forum. I personally am looking forward to learning from them all, and I hope you do as well. I thank you, and God bless you. May I now take the honor and privilege to introduce our first guest speaker, Dr. Michelle Jane Paul. Michelle Jane Paul.
Thank you so much.
Jane Michelle Paul. He's a serial entrepreneur and an academic living in and speaking today from Singapore.
Hello. I do apologize for my confusing name. I know my translation is.
That's fine, sir. We will cope.
Okay.
We will cope. He's the CEO and founder of Acheron Capital Limited, a London-based investment management company specializing in decorrelated strategies. He's also the CEO of Real Estate Analytics, a Singaporean property technology company using artificial intelligence to empower and transform the real estate market in Asia, recently selected as a top 20 Asian property tech firm. He's also a co-founder of Akinova, an electronic marketplace for the transfer and trading of insurance risk, voted Europe's best insurtech 2020, and valued today at $250 million. He was previously head of research Asia Pacific for Rabobank and senior analyst at Atlas Capital Group, where he was managing a $500 million hedge fund portfolio. He teaches at the University Libre de Bruxelles in Advanced Master in Finance and is a board member of that university's research foundation. He's a graduate of Solvay School of Commercial Engineering, now SPSEM, and has a PhD in finance and real estate from the University of California at Berkeley. He's a chartered financial analyst and holds a graduate certificate from Stanford University. Dr. Paul has co-authored several academic articles and published multiple articles in Bloomberg and the Wall Street Journal, where some of his pieces have attracted over 4 million hits. He's the author of the groundbreaking book, The Economics of Discontent, available on Amazon Kindle, where it has been #1 in economic rankings for 2 years in a row. And as I have said, we will pledge to make a copy of that book available to BusinessDay subscribers following after this conference. May I now invite our distinguished guest speaker, Dr. Paul, to take the podium. You're welcome, sir.
Thank you so much for this very kind introduction. In time of uncertainties, it's often appropriate to take a step back. And my way to take a step back was to spend time with my eldest son. And it's a special time where, as a freshman, he was about to go to university at Caltech. So on my way, I talked with him about our family, my grandfather, his grandfather, how he was an agronomic engineer for the FAO in Africa, where he's buried. And I tried to inspire him, to give him some vision as to the great things he could do in his life, despite all the uncertainty and the stress that was about to be overcome the next 4 years as a freshman, and that he had to work hard to be tenacious, creative, and that if he did all this with integrity, it will be a success. He's young, he wants to better the world, as all young people do, and he will do biocomputing, working with a very famous Chinese scientist, making computers out of atoms. It's hard to believe, but these computers out of atoms play tic-tac-toe, and they actually showed me it's real. So as a father, that was an important trip. As an economist, it was a very interesting experience. You see, my son had been attending the extension school at Harvard since 15 years old. He was first of several classes there in mathematics at Harvard College and was a teaching assistant, the youngest. And the professor obviously invited him to join. But despite all this, he was not accepted at Harvard when he applied as an undergrad. So do you have my... so, okay. Sorry, sir, here, I want to make sure. Yes, so it got me thinking, I mean, how is that possible? I mean, he was accepted only in Berkeley, Caltech, and Cambridge. What was wrong? And since I have written my book, there were several interesting legal cases that appeared in the press on the corrupt admission practices, the bribery, and the fraud at universities in the States. Okay, they actually call such admissions the side door. You see, you have the front door where you go on your own merit. You have the back door when you give to the university, and you have the side door when you give to people in the system. But leave that aside, because the back door is much more interesting. See, the back door is essentially a legal form of corruption. There are legal ways to bribe your way to get admitted in the best universities. Famously, Jared Kushner, Donald Trump's son-in-law, was accepted into Harvard shortly after his favor donated $2.5 million to the university, entirely coincidentally. There are also legacies, like you bribe over time, deferred payment. You make regular donation to your alma mater, and your progeny will be admitted. 1 in 7 Harvard students is a legacy, and nearly all of them are white. Or maybe you should be good at sport, but which sport? It turns out to be sport where, a proxy for wealthy family connections, like a polo team, maybe rowing, or golf, essential skills, no doubt, in life, which all happen to be extensively linked to the amount of money you can spend. Between 2009 and 2014, 43% of white students were athletes, legacies, faculty kids, or offspring of major donors. Since then, these numbers have gotten worse. More than half the WASP enter for the back door. In proof, in a meritocracy, a majority of the white students there should not be there. And unsurprisingly, the portion that should not be there by design all come from extremely rich background or connections. In proof, intellectual abilities no longer are recognized by the most branded education system. It is important because Ivy League's college are now admitting more students from the top 1% of the income distribution than from the 60% bottom. This, by the way, from the university with the largest endowments in the world. They hardly need money. It's called greed and a lost sense of purpose. The US attorney from Massachusetts, Andrew Lehrling, stated when investigating that there can be no separate college admission system for the wealthy. But the fact is, there really is. And that's even more important today for nearly 50% of American corporate leaders, 60% of its financial leaders, 50% of its highest government officials attended only 12 universities. Not only is the share of income going to the top 1% in the US the highest since World War I, but it will be even more so, for the social mobility of education has all but disappeared, except for a few universities like Caltech or Berkeley or MIT, who will stubbornly select on merit. Old-fashioned, not financially rewarding, I know. But then, did I tell you we're designing nanocomputers that already play tic-tac-toe? Caltech, it turned out, was a wonderful place with the most Nobel Prize professors per students. Incredible stuff. Definitely worth the trip. They did not shoot Back to the Future there for nothing. But traveling there was tough. Going to the US to bring my son was quite an adventure. I was stopped for 5 hours by passport control in the US. You know, locked in a little room with 50 people, cannot touch a mobile phone. And then going on the world to visit London, I was stopped again. I asked multiple questions. Thanks, Brexit. And when back in Singapore, after showing no less than 5 new forms, I had the great pleasure of doing 14 days in quarantine. I'm actually talking to you from quarantine. I have 10 days to go. Wish me luck. For traveling, even before COVID, was getting harder. In fact, the world is closing down. We have had a period of globalization. We have now entering a period of nationalization. It is just starting. And the foreigners, even the visitors, is not welcome, or at least not as welcome. Consider, for instance, that Singapore, which was built by importing foreign talents, has seen the largest drop ever of foreigner last year. And why is it stopping? After all, people like me, in the lucky international elite of the Western elites, had a really good time with globalization. But it is time to reveal the dirty little secret of globalization. It was not good for all. Competition from the low-income countries with free trade meant whole segments of the Western industry disappeared, and with it, jobs of the less skilled. Add to this, mass immigration of untrained but eager to work people, which meant more competition on the lower end of the wage scale, more demand for benefits, more demand for trained public services, more demand for schools and hospitals, which meant tough choices and a lower level of public service. No, it was not good for everyone. But what has changed that suddenly made globalization, and especially immigration, so seemingly be bad? After all, more people willing to work hard and people who have demonstrated willingness to risk it all to go there should be a good thing. Well, previously, low education level of such migration was de facto welcome, for the social mobility was high. It was replenishing the social pyramid by the bottom, while the previously based moved up. It was a wonderful form of social escalator. Everybody won. But as we saw, social mobility decline. No more upwards move, social stagnation, whatever your potential and skills are. And as it did, so did the acceptance of immigration. And so we are now in a world where the resenting low and middle class want to close the border to both foreign goods and people. According to a recent survey, 94% of Nigerians believe globalization is a force for good. Right, it makes sense. They're absolutely right. But only 29% of French think so too. And from a part of the population in the Western countries, that absolutely makes sense too. So we will see less mobility of wealth between countries, less trade and less legal or illegal migration. The door is closing. For the poor of the wealthy country have had enough. They left the traditional parties and are starting to vote at the extreme spectrums of the electoral offering. Extreme left, extreme right, for they don't really know what to do except that they are upset and resentful and that it cannot go on. But extremes that actually joined in rejecting globalization, creating a new political axis of confrontation. And the issue in a democracy is that this deprived and increasingly rebellious underclass, they may not earn as much, they may not be as educated, but they have an equal vote. And they have started to realize that they are, in fact, a majority. And they no longer care that the elite and media are calling them dummies. In fact, it invigorates them. For they may be dummies, but they now perfectly understand that they have been the fools and losers of globalization. So, uninvited, unwelcomed, reprimanded by the media, here was Brexit and Trump, and a lot more to come as the COVID bill will unfold. This is not an accident, but a trend, and it is there to stay. So, after my 5 hours rest in company of the Homeland Border Protection officers in the US, when I finally got to Caltech, I found a fantastic campus, absolutely inspiring, Club Med style, and I took lunch with my son. I didn't want to give him bad habits, so I decided I should take him for a cheap lunch, with a cheap lunch and cheap coffee on campus. And this was so expensive compared to my time doing a PhD in Berkeley that I could have fainted. See, as a poor PhD student, I used to complain paying for much craved for latte between $1 and $2. And now they ask for $6. So it's okay because I now have a stock of portfolio investment and they're doing surprisingly well. But still, what's going on? I mean, clearly, economic growth has been limited in recent years. The euro area GDP has been flat since 2017. It's been growing at about 1% in real term a year in the last 15 years. In the US, it's a bit of the same story. In nominal terms, the GDP has increased from 2007 at 14 trillion to 21 trillion today, up 50% in 15 years, which is, give or take, a 3% nominal growth. Yet, the S&P in the same time has increased from 1,300 to 4,400, nearly 3 times, close to 10% a year. 10%. Now we're talking. But think about it. If the real economy goes up by 1 or 2% a year, how can the stock market go up by 10% a year? How come stock can grow by 10% and the real economy 1 or 2%? Is this possibly sustainable? Intrinsically, it means that as the pie that we produce grew a bit, the share going to owners rather than workers grew a lot. In more fancy economic terms, the GDP share attributed to capital is increasing at the expense of the share going to labor. In real terms, the wage of an American family has not risen for the last 30 years or so. Quick note here, this obviously cannot go on forever. At sometimes it breaks, and we will see when. Okay, but to start, how can this be happening? Here comes quantitative easing. We all read about it, the famous QE, the fancy name QE, also known, AQA, as central bank balance sheet expansion. Easing, expansion, sounds nice. much better sounding than old-fashioned money printing that our professor and history books warn us about. The power of spinning communication, of making fancy new words, but we still stand at a precipice. Since 2007 to now, the amount of money printed by the G7 central banks has, grosso modo, increased from $5 trillion to $25 trillion. Wow, think about this, times 5. 5 times more dollars and euro and yen bills. But I mean, in truth, they don't really have to print them anymore, you know. It will be environmental and friendly. All this paper. No, in the modern QE world, a central banker just change the number on the computer. So not so hard to make times 5. And when they do, what they do with it, when central banks buy government bonds, the state-owned debt owned by the private sector, the private sector sells it and makes a big profit on it. And then interest rate goes down, and the private sector reinvests the proceeds in stocks and real estate, and price of real estate and stocks goes up, asset price goes up, another sense of big profits, and government can spend and issue more debt, cheaper. Frankly, what is not to like? Everybody's happy on a high, except that the real economy does not change just because you print money. So these higher asset prices, they are like asset inflation, you see. We had consumer inflation, this is asset inflation. There is more money purchasing the same amount of assets. It leads to higher asset price, but it's completely a nominal gain. There is no more real asset. Since, per definition, only the wealthiest own most of the assets, well, they are the ones who mechanically made money out of this QE. From the QE induced asset price increase. Lots of money, 3 times, remember, for the S&P. Not really doing anything, just waiting for the central bank to print. No harm done, wealthy getting wealthier, central banks buying government bond, printing. Of course, the middle class had a harder time. They have little assets, income did not go up, so owning things is becoming even harder for them. No chance to move up. For instance, it is almost impossible for young couples to buy real estate or making any decent saving for future pension and consumptions at an older age. But no harm done, it is just easing and expansion, remember? Not money printing. Until one reaches a point of spillover. You see, printing is addictive. It's like a drug, especially to politicians. Any government will tell you, there's nothing like free money. It allows you to finance fancy projects with no tax increase. Just let the central bank buy these bonds and give money to people who can then vote for you to reward you. Nothing like it. Everybody's happy. In the short term. Short term because in the long term, the falsely leading real interest rate, the easy money for all, means the financial system is really breaking down. By this, I mean it breaks down because it's no longer shifting the resources to where it is needed, to the new companies. Actually, half of the companies now in the S&P are called zombies companies. They can barely make payment on the interest, which is nearly non-existent. Instead, it is enabling these companies not to go bankrupt. They stay on using resources that should be put to better use elsewhere. Productivity and long-term growth fall as a result. In the long term, we all get poorer. Short term because at some point, people stop trusting fiat money. The loss of trust in money. You look at the dollar bill, you see in God we trust, but actually we all believe as we trust this piece of paper. And that's a good thing because money is a collective good, a commonly agreed delusion. It allows trading, saving, measuring, and it could easily be shattered. I don't know for you, but did any of your children talk to you about cryptocurrency? is something with no value behind it, but the next generation prefer to this paper money. Why? Well, in a sense, why not? At least one cannot print new Bitcoin. Supply is fixed. Short term. Short term because at some point, asset inflation becomes consumer inflation. We are right there. German producer price index went up 12% recently. 12%. Not seen since the 70s stagflation. Remember that share of production systematically going more and more to capital and not to workers? PPI, producer price inflation, is a way to correct that and reverse that. It is a way to send the revenues to the producers, and it is just starting. Short term. Short term because it put at risk the fabric of society and its social contract. Our money printing addicted societies have enriched the wealthier, not to reward value creating entrepreneurs and economic operators as in this conference, and as it should, but just as a mechanics of QE that automatically makes the wealthy wealthier. These had collectively created distrust of wealth. It is one thing to be rewarded for creating economic activity. It is another thing to become wealthier just because the person was wealthy to start with. So discredit to wealth is one of the critical unforeseen social consequences of QE. Property is a social contract. If people stop believing you deserve it, it can quickly be taken away. Watch out. Berlin population, exceeded by real estate prices, just voted to expropriate landowners having more than a certain amount of properties. All societies are built around a social contract. We have different views, sure. More fairness or more efficiency, more consumption today or more investment tomorrow. These are legitimate questions. But basically, we agree. We have been agreeing since World War II, but this social contract that has benefited all of us is disappearing. What we are witnessing is the end of the Western social contract. No more social mobility. The end of globalization. Political shift to the extremes, even if no articulate strategy is proposed. For it is a rejection of the situation rather than the adoption of a new project. Ever more wealth for being wealthy because they are, not for creating value. It smells like Marie Antoinette brioche. It's the end of a model that has reached a cul-de-sac and that they cannot continue. It is a source of our uncertainty. The signs of weakening points are clear. Trust in money is disappearing. Inflation is up. Disruption of the supply chain is everywhere. Property is being contested. All these are triggering strong social movements, but will only be worse once COVID stops. History, like nature's, hates emptiness. At the same time as we reach the end of the model, an alternative system to the Western world is emerging. China, with authoritative leadership, lots of white shores and visions there, breaking up tech monopolies, forbidding gaming to the extreme, flattening of education, but together with an eagerness to supremacy, a fragile trust in the system, and at the same time an economic slowdown. An economic slowdown not because of the pandemic or even of the middle income track, but as a logical consequence of the renationalization of world trade, which made China such a beneficiary, and of the limit of centralized bonified investment making. And what about Africa in all this? So what are Africa and its leading country like Nigeria to do in such a context? Well, some of the good news is that raw materials price will go up. Commodities in terms of inflation is not a bad thing. A bit of competition between China and the West of Africa is not a bad thing either. Competition is always good as a consumer. But still, these are uncertain times. Beware Western world, but is unsettled socially and that could lead to radical reaction. And in a classic Thucydides trap, clash between the declining privileged West and the emerging China, a clash that could easily go out of hand. There are some lessons to be learned as for the development model too. Integrity. Western societies love to preach about good governance. Not so true, in fact, in the West, as we have seen, for the system is rigged. One should take with a grain of salt the moral advice of the priest on Sunday that has mistresses during the week. But the basic idea of good governance is right. Chief among them, we need to find ways to preserve social mobility. For this, education is key, and not education to send the best Nigerian web brains abroad, but rather to keep them here or to make them come back here to develop the future of this continent. Today, a bright African student now in Caltech with my son will not return to Africa, but he should, because he or she is needed here to build the future. Financing system for study abroad programs should make sure of that. Think of the Singaporean bond system as a successful model. The most undervalued African resources are its brightest people, and the West is taking them far too cheaply, depriving the continent of its much-needed future leaders in the process. Tenacity. Development is not an easy road. It's a long-term task requiring endurance. Investment in the production of goods that will still be needed in a faltering international trade environment should be pushed. Commodities, of course, but also development of local production. For less international trade will result in more balance of payment difficulties. That is an opportunity as well as a challenge. Creativity. Consider that new technology can allow to leapfrog. Europe has spent lots of money on highways and roads, but if we have flying delivery with drones, are these trucks and roads so much needed? Not as much. It has built huge networks of ATM, but with mobile payment, lots of them are becoming useless and costly to maintain. There are plenty of examples of new technology that can allow for rapid growth in Africa, from fintech in banking to proptech, we do amazing stuff in Singapore, to logistics. Leapfrog creativity, skip a stage and go above and beyond. As I left my son in his dorm and I took a last look just a few weeks ago, I had a little tear as a father. And then I saw a figure engraved in the floor next to his dorm on the courtyard, and it made me smile. There was a triangle in the stone. At its base was integrity, and then tenacity and creativity. These are what leads the entrepreneurs and economic decision makers to the summit, as in this conference. Thank you.
Thank you very much, Dr. Paul. What a wonderful presentation. Thank you so much. We do expect a short Q&A, so there'll be questions, but as we settle down, let me just, there's something that you said, and you said at the final part, which really struck me. How it is that our children are being attracted to go get decent education abroad, and how it is that only fewer and fewer are returning or have the intention of returning. But perhaps more telling, how it is that the advanced countries are getting our very best talents for the cheap.
Yeah, to create one engineer, you need about 1,000 people if all the primary education goes well. To create a doctor, you need about 1,000 people. So whenever there is, and it's very true, the brain drain for Africa, it's partly true for Europe to the US. When our brightest go to US university and don't come back, we don't just lose one engineer. We lost 1,000 people that we trained. We don't just lose a doctor, we lose 1,000 people that we train. So that even if they somehow repay the education that they got, they actually are draining the country resources of education of a multiple of that. Okay? And this is a terrible indictment, because taking out the best brain is, taking a mortgage on the future, because this is a real resources. Africa is blessed and cursed with commodities. It is blessed with bright people. But if these bright people leave, it will be very difficult to build a future.
Can you, Dr. Paul, elaborate a bit on what Singapore does to reverse this trend?
Sure. Singapore was faced basically with the same kind of problem. It had, a number of smart people which could attain a certain level of education in Singapore itself. But, looking 30, 40 years back, Singapore was not as developed it was essentially a poor country. And the leadership of the time, Lee Kuan Yew, clearly understood education was key to the future and to the development. So they came with a bright idea. Let our young people go and get this extra level of education abroad. But if you do, somebody has to guarantee family, and you will have to commit to come back and work a minimum of a certain number of years corresponding to the number of years you study abroad. We pay for you for 1 year of a master, say, in the United States. But you have to come back and you will have to work for, say, 4 years for government or 8 years in private sector, and that debt will be forgiven. We would have had to pay for your education here anyway. If you don't come back, you're going to have to pay a multiple of the amount we paid for you. That's the basic Singapore bond system. And it worked well with the elite Singaporean being educated at the highest level in the best universities in the UK and in the US and coming back. And what we have seen afterwards is a Singapore economic miracle of a very poor island with no resources doing extremely well, thanks to an educated elite that came back.
Thank you, sir. We are getting questions via our Slido. So to our audience, you can log in to Slido and put in your question. Let me just ask, there are two questions that have come in and I would ask them together, Dr. Paul. Firstly is, you have highlighted the role of the central banks around the world in providing easy money. And I'm sure that is partly responsible for how it is that while the real economy has only grown by between 1% and 2% annually, the value of stocks, or indeed the wealth of investors, which is like a very, very tiny group of elite people in society, has grown by something like 10% per annum. Yeah. Now, what else do you think has contributed to this? Isn't there a place, besides the point that you make about central banks printing money, or in fact, as you said, they no longer have to print it. All they need to do is just get a computer and change the number of zeros. Mm. Now, isn't there also responsibility to be placed on leadership in the various countries, like countries in Africa and in the rest of the world? And perhaps the second question, is this collapse of the social contract irreversible? Thank you, sir.
Okay, very, very good questions. So it's a set of policies that have created this situation. The QE is only the latest and most dramatic phase of it. And printing money is very often the sign of the end of empires. From Roman time, this is always how it goes. But it started, as we have seen, in education, and then you have the same in healthcare, and you have the same in antitrust laws, and you have the whole set of policies that essentially give a privileged rent to a few. And the privileged rents contribute systematically to the centralization of income and wealth. Now, in the end game, it always is money printing, and QE is money printing. And it's not just easing, it's money printing, and big time, 5 times 5 in less than 15 years. It's massive money printing, or as you said, just changing the numbers on the computer. Is this irreversible? What is pretty clear is that the social acceptance of this is coming to an end. This is why we had the Gilets jaunes in France, the Trump violence and manifestation in elections in the US, the Brexit in the UK. You have everywhere this kind of revolt of the lower and middle class who no longer believe in the mainstream speech, and they don't know what to do. They're not led. They are just resentful, and they go to the extreme, which is why you see, look at the next French elections, they're already saying Marine Le Pen will have 40%, which would have been unthinkable 10, 15 years ago. And at the same time, the extreme left will do very well. They're talking about 15% for them, which is very high. So the extremes are doing very well. They don't really have any answers, but they're doing very well because people are upset. Now, what is interesting is that these extremes actually have lots in common. So extreme left and extreme right both reject the system. And that is a little bit the political recipe for our end of system. If you continue printing money, if you continue these policies, you will have a declared majority of opponents that will bring it down. And indeed, it will be the end of the Western social contract as we have known it.
Interesting. Okay, one other question that has come in. Given that our audience is predominantly business leaders, senior executives, chief executives of businesses,
yeah,
their key mandate in their roles is to ensure higher returns.
Yes. There is nothing wrong with higher returns.
Let me just finish. We are seeing that this desire is almost now running in conflict with the desire of the rest of society. So what should business leaders do?
Okay, it's an excellent question, and it goes into the heart of the matter. The problem is not about fairness and equality, which was the old debate. Okay, we need business leaders. We need people as in this conference because we are creating wealth, real assets, real productions, which is for the betterment of everybody. And if we take part of what we produce, there's nothing wrong. Okay. The problem is if you print money and you just got wealthy doing nothing, that's when the social contract is broken down. If any of us here is getting millions of dollars doing nothing, there's something wrong. If we're getting millions of dollars because we created a company that created jobs, that created goods, it's all good for society. So we translate that in rate of returns. Yes, excellent. We should all aim for rate of returns. It is a measurement of how much we contribute to society, and we should be proud for it. But we should not be happy about a situation where people doing nothing get wealthy.
Thank you. One more question that has come in, Dr. Paul. You know, there's a friend of mine who says that the poor is unable to sleep because they are hungry. The rich cannot sleep because they are afraid of the poor. The question we have is, what we see today manifesting in things like Occupy Wall Street and anti-globalization protests around the world, and as you have said, the shifts to the extreme in France, for instance, is that a taste of what will come? Are we going to really be faced with, that's the world, faced with more violence in the years to come if this shift is not reversed?
Yeah, unfortunately, I believe so. I mean, and you can observe it first, say like cybercurrency, as we mentioned, you know, Bitcoin getting so much high, it's kind of moving away from, you know, fiat money, right? But look at the amount of political violence we have had, not just in France. Look at, you know, the Congress in the US was attacked by the mob. I mean, it's totally unthinkable. Now, because of COVID, you know, this kind of cocoon that has pushed and locked down literally the population. But as soon as that reopens, and with the bill of COVID to be paid, if these economic policies are pursued, there's no doubt in my mind that it will turn violent. And actually, if it doesn't turn violent, just look at what just happened in Germany. We just have elections there. It's a country that is much more susceptible to avoiding the extreme for historical reason and trying to preserve the social peace. But even there, you have it in another form, because in Berlin, they just voted to expropriate landowners. You know, so if you have more than a certain number of flats in Berlin, it just got expropriated.
One other question that has come in. Dr. Paul, you are a teacher in the university. And the question is, does this have any imperative for how the curriculum for especially business school that train leaders who then go into commerce and industry, does this have an imperative for how the curriculum of their training is rebuilt, or what do you think? What's the role of business schools in reversing this breaking social contract that you have so lucidly spoken about this morning?
Well, it's a critical role, of course. I mean, the role of university, first of all, should not be to learn by heart things, but to learn to think. So as teachers, as professors, we have to question our students to make them think by themselves. And as we do that, we have to deconstruct what things are, like money. We all talk about money. Every course I make, I sacrifice 20 euro that I give to students, and I ask them to burn it. I ask them to burn it, and then I ask them what happened. A piece of paper was burned, and 20 euro was gone. But it forces them to think about what money is, which is a collective delusion. We all believe that this piece of paper has a certain value, $20, say, effectively, but is meaningless. But collectively, we decide it's a meaning. And once you understand that money is just a social contract, then property becomes a social contract, and it becomes important, but whatever we do is within this social contract. Talking of integrity and all this in the absence of understanding that we are part of society is meaningless. And I think business schools have to start there and teach all the good methods that they do to increase the level of efficiency and production and all this, building on this understanding.
Thank you, sir. We will be rounding up shortly. Let me just ask you one question. Given that countries in Africa, especially a country like Nigeria, more than 200 million people, significant a challenge of non-inclusion, what would be your counsel for leaders who create policy, and then, of course, for leaders in business and industry who have to operate in the very challenging environment that we speak about today?
Okay. So first of all, to realize that we are indeed in a very uncertain world where the rules are changing. Do not take the rules that Western countries or tomorrow Chinese wants to impose to you as the rules that you have to take. And Africa has its own society, and the rules should fit the society. Okay. Now, within that society, we need to focus on creating the basis for future growth. And the basis for future growth is there. There's plenty of wealth and commodities and so on, but as I said, that can be more a curse than a blessing. The real wealth are the people. They need to be programmed to select the best among us, the best among Nigerians, and to train them and retain them. And then naturally, the society will get wealthier.
Thank you very much. I don't think there is any other question. I believe what is left for me is to express profound appreciation to Dr. Paul, who has taken out time today to speak to us. And I can sense and just, looking at your book, I can see why you are passionate about this matter. Seeing the book, I can link it to the personality behind it. Dr. Paul, we are so very grateful for your time, and together with you, we hope and expect that the world would heed the counsel and begin to come back from the brink. Once again, I thank you so very much. Bye-bye.
Thank you so much.
I will now be handing over to Dr. Adun Okukpe, who is moderator for the next panel titled Changing Business for a changing world. This is so fitting given what we have just heard Dr. Paul tell us. And I believe that there will be a lot that the panelists in this panel will be taking into cognizance in their conversation. Dr. Okupe is a lecturer at the Lagos Business School of Pan-Atlantic University. Her research and teaching interests are in the areas of behavioral economics to understand decision-making as regards leadership for social change, socio-cultural leadership, tourism, and leisure studies, and the impacts that they have on sustainable development in Nigeria and around the world. It's my pleasure and privilege to now invite Dr. Okupe to take over and lead the next conversation.
Right. Good morning, everyone, and thank you for joining this session. I'm just changing my background from black and white. So as I've been introduced, my name is Adun Okupe, and I'm looking forward to this session where we'll be looking at changing business for a changing world. As we all know, technology, digitization have really affected market trends, and we have to now deal with more complex supply chains. We have to look at regulation, we have to look at work practices, as well as climate change and gender representation. And so if we compare where we are now to where we were about 10 years ago, we see that the world has changed and business needs to change to meet these demands. But more than that, we also believe that business needs to anticipate some of the changes that are going to take place. And so joining me today, I have 3 panelists that are leaders in the business world, and they will be sharing some of their insights, some of their lessons, as well as looking at how we can anticipate the future trends for our world today. And so I have Dr. Akintoye Akindele, who is the Chairman CEO, Platform Capital Group. Good morning, and thank you for joining us.
Good morning. Good morning. Thank you for having me.
Thank you. Then I have Ms. Eleho Iboni, who is from Shell Nigeria Exploration and Production Company Limited. Good morning.
Good morning, and thanks for having me today.
Okay. And finally, we have Ms. Ireti Samuel Ogu, who is the CEO and Country Officer for Nigeria and Ghana City, Nigeria. Good morning, Ireti.
Good morning. Thanks for the opportunity.
Okay. So in terms of how this session will run, we'll use a standard format where I'll throw some questions to the panelists. If you have any questions, you can put them in the chat box or in the webinar question box, and then I will leave some time at the end to address some of these questions. So I'll start actually with Ireti. Can you share some of the key changes you're facing as an organization, as well as within your industry, and how you have been navigating some of these changes?
Thank you very much. In the banking industry, I think you can identify 6 changes, I'd like to say. The first one really has to do with the rapid pace of digitization. We see that with the growth of artificial intelligence, big data, and very soon we're going to hear the announcement of the Central Bank of Nigeria issuing the e-Naira. So we're going to have a digital currency as well. I think also linked to that is the second trend I would like to call out, which is the growth of fintechs. And fintechs, you could perceive them as being competition, but we like to think of them as co-petition, which means that we see fintechs really as collaborators and part of the same ecosystem. And also fintechs work closely with banks, so their clients as well. So that's one way in which we've been able to tackle that emerging trend. I think it's fair to say that we are in a rapidly changing environment from a regulatory standpoint, not only local regulations, but also offshore regulations as well. And over the years, banks have just been more and more regulated because when there's an issue, you bring up regulation, whether it's Basel regulation to ensure banks are properly capitalized, or other regulations that have come up in Nigeria as well. So the regulatory environment is quite rapid and impacting banks. From a client standpoint, we can't help but notice the change in our clients' business models. And of course, COVID has accelerated that, where our clients are dealing more digitally with their clients, and they're going direct to consumer. And so e-commerce has been birthed. So rather than the bricks and mortar, which a lot of our customers have been accustomed to dealing with, they've now set up online ways of communicating and of selling with their clients. So it means that banks have to evolve the way in which we serve clients, because it has to move to a digital format. And that's where evolutions like open banking would be very helpful, because it allows consumers the opportunity to have optionality like paying by bank. Then to the topic that I picked up from the first speaker in terms of another trend which is impacting, not only banks, but I'll talk about it from a banking perspective, and that's the whole globalization trend. Globalization is one of the secular trends that we're seeing, and what it means is that companies can start off in one country one day and become, global the next. And so digital natives are born that have multiple country jurisdiction. And last but not least, the environment and the sustainability and how that impacts our way of life. Thank you.
Wow, thank you so much, Iriti. It shows that there's quite a lot of change moving on. And from what you've explained, I would like to pass it on now to Toye to speak a bit about what's happening, because I see that the two industries are quite linked, before I then pass on to Eloho. So in a few minutes, Toye, can you share some of the key changes you're facing, both as an organization as well as an industry, and how you're trying to navigate some of these changes?
Okay, thank you, Adon. So for me, I think my view is the more things change, the more they stay the same. Because really, if you find out that, if you follow the trends that we are seeing, both as an organization and industry, they've been around for a while. Those things have been around for a while. They're just a lot more pronounced. Let me first start. There are some common themes between organization and industry. One of them is, finally, the whole world is awake to women being in business and being professionals. For example, look at this session. I'm the only guy in this session. A while ago, this was a misnomer, right? I feel minority. So, now a lot of people should understand how women have felt for a long time. I feel like a minority here. I'm looking around, I'm by three powerful people and I just small me. But women-led businesses is no more a thing to worry about. It's now mainstream. And that makes sense, right? Women's professionals. Any company right now who is not creating an environment to accommodate women is losing out not just on top talents, a major part of the professional base on one side. So having policies that will ensure that that gender equality is actually not something that you're now focusing on as a priority, is mainstream, is important. It was always important, it's now more so now, because that is what the management bench and professional bench looks like. That is one. Second thing again, it's about your team. It's important that, especially for most of us in business, and the most important asset on our balance sheet in our business is not on our balance sheet. People, it's not there. So it's easy for you to forget people are the real reason why a business exists. You may deal with City or with Shell or with Platform. We are dealing with people. So any company who is not looking at people as a core asset and find a way to ensure that asset is yield optimal, lose from the volatility in people, like the volatility in assets, people will come and go. But the core base of it, how you keep your team. So team is very important, and getting rid of team. Again, it's been around for a long time. It's still there. It's just getting more pronounced. We speak about digitalization and innovation. We've always been about innovation for entrepreneurship. But guess what? In a rapidly changing world where borders are now gradually being eroded by technology, where you have a lot more knowledge being available, where you have a lot of data being available, where you have exposure, where you have attention, where you have capital flow. What is happening right now is that business models are scaling faster. It is no more good enough to be a local champion. If you have a business model that only focuses on what you solve in Edo or Ibadan, you can't scale. There's a premium being praised for scaling across borders, across markets. Hence, the rise of unicorns. This year alone, we've seen 239 unicorns globally. Africa now has about 8 unicorns. Oh, I'm sorry, 9. Another unicorn was formerly studied by Andela. It took us almost 60 years to get the first unicorn in 2019. 2019 to now, we have 9 in 2 years. Guess what? We predict 12 more in the next 2 years. So, and these are African unicorns coming to the table. So how about you understanding that the element in all these businesses is one thing, is scalability, it is experienced team, it is exposure, it is data, and it is models that actually solve real problems. I've always said this, whether you like it or not, Africa is the future. If Africa gets its act together, Africa will be a leading continent. If you don't, we'll be a problem continent. Either way, in the future. So for us right now, it's about maximizing the global themes, following global thesis, leveraging the important things. The SDG goals have been out for 70 years, to borrow David Sachs. SDG goals are not new. It's just now we're putting attention to it. So the changes driving us is now time to take the important things seriously, because no scale, no growth, no stability without the fundamentals. And that's what I'm going to leave it at that.
Wow, thank you so much, Toye. And with all the different changes you've mentioned, I'm a bit worried that we won't have enough time in 55 minutes to go through them. But some of what you said, and I'm going to spotlight it well, I didn't want to talk about the gender representation on this session, because you're right, you're the only man, but that's a good thing. And yes, what happened with Andela in terms of SoftBank investing about $200 million has really made the evaluation. I think they're now valued at about 1.5 billion. So that is really showing that Africa is the next frontier. And so I'll come back to you, but I'd like to go to Ms. Eloho, who is the MD of Shell. And can you just share with me some of the changes you're seeing in the oil and gas industry, as well as an organization, and how you're trying to navigate some of these changes?
Yeah, you will agree with me that we are living in unprecedented times. Change is more of a constant these days. For me to be able to reflect on this question, I would love to look back 10 to 15 years. But like you said, time will certainly not permit me to do that. So let me start from 2020. The oil and gas industry, we experienced a third oil price collapse in 12 years. And that was mainly due to oil oversupply of oil. And that shock actually came from the OPEC plus countries. And then you then combine that with the unprecedented demand drop, mainly due to COVID, and how it affected the global economy. This year, we're beginning to see signs of recovery with higher commodity prices, sadly. And with the volatility in the macroeconomic fundamentals of the oil and gas industry, and living with a constant uncertainty, clearly this is one key change that we're all having to adapt to in this sector. Another key element of change we're dealing with is around the energy transition and how we are leading through it. At Shell, we are navigating through this energy transition by creating a refreshed strategy, which we call Powering Progress. And with that, we're mainly focusing on 4 goals. We're powering progress with our customers across all the sectors to accelerate the transition and also to achieve net zero emission by 2050. We're creating value for our shareholders by providing financial strength to transform our company as the world makes a transition to cleaner energy. And for us, powering progress means empowering lives and livelihood through our products and activities, and by supporting an inclusive society. We just talked about our people being the asset. We've just talked about creating that inclusive society, and that's one thing we're focusing on. And the last one for us is we've got to respect nature. And by that, we are protecting the environment, we're reducing waste, we're making positive contribution to biodiversity. And clearly, it means that we've got to develop a resilient and high quality upstream portfolio. And that's the only way we can meet the energy demands of the world today, while unlocking value-driven growth to meet the lower carbon emissions demands of tomorrow. And the last one, which Dr. spoke about a couple of minutes ago, it's digitalization and technology. For us to be able to drive efficiency in any organization, we must embrace digitalization and technology. And if we say our people are the assets, we've got to focus on reskilling them. That's the only way we can catch up with how the world is changing. And then we can begin to drive transformational changes that would help develop our economy.
Right, thank you so much. Again, I like that you've expanded the list of changes, and something that is quite important is that the oil and gas economy also affects other economies. And so some of these interrelationships we will be exploring. And just to remind attendees, please, that if you do have any questions that you would like to ask, then please send your questions into Slido, which is slido.com, and use the Slido code, which is hashtag CEOF21. And also then let me know who you would like the questions to be directed to, and so that I can ask the right participants some of your questions. And now, Ireti, I'll come back to you just to talk about some of the changes you've mentioned, particularly the e-Naira. I would like you to share some more about the e-Naira for those of us who are just hearing about it, as well as fintech, the fintech industry, because we've seen that sometimes the general perception is seen that is there a competition between the banking industry and the fintech? But like you've mentioned, it is really about collaboration and seeing how the ecosystem can work better to embrace the change that we're meeting. So can you share some of your reflections on that before I go to my next question?
Thank you. In terms of the e-Naira, I think the best way to think about it is digitizing the cash in your pocket. And what it does is that it gives you the ability to convert, or it gives the central bank the ability to convert some of the cash in circulation into digital format. So it means that you can reduce the amount of cash you carry, reduce the costs associated with cash. It means that it helps to improve inclusion because if you don't have a bank account, you have a phone. There are more people with phones than bank accounts. So it helps to improve inclusion. And it helps e-commerce as well, because you can pay. That's the optionality you have. It means that people who don't have cards and who don't have bank accounts can also engage in online buying as well. And ultimately, it can be used for cross-border transactions, because as long as the counterparty accepts Naira, they can have it in their wallet and spend the Naira. So it has the ability to transform the way in which we operate in Nigeria today. Moving on to fintechs, I think this is quite a controversial topic in terms of whether they compete with banks or whether they take away banks' share of wallet and so on. I think one thing for me is clear. Banks have legacy and perhaps are slower to respond. Fintechs are agile and quick to respond, quick to create or to leverage technology and to create technology solutions, but they don't have legacy and long-standing client relationships. I mean, Citi, for example, has been in Nigeria for 36 odd years and has been around globally for 200. Fintechs are younger than that. So I see it as, no matter what side of the fence you are on this, I do think that there's a unique opportunity for banks and fintechs to collaborate, because it's a perfect complementary relationship.
Okay, thank you. And talking about that now, I would like you to share with us one major lesson you have learned on your change journey in the banking sector, and perhaps reflect on how this is also important to other business leaders from other industries?
I think the whole sustainability agenda is very pertinent and thinking about the impact of what you do and the responsibility you have in terms of the future. So to act responsibly, and one of the city's aims is to be a trusted partner to our clients, to responsibly provide financial services, and to enable economic progress. And I think thinking about those things, if you think of what banks were focused on a few years back and what we're focused on now, it's very different. So we're very mindful of being relevant and taking cognizance of the environments in which we serve. I think probably about 8 years ago, the CBN published 9 guiding principles for banking. And in there again, it's about gender, inclusion, sustainability, thinking about the environment and so on. So I do think that the one change that we have learned as bankers is really to be more cognizant about our environment and about being part of sustainability and adding value in a play forward manner.
Indeed, and like you said, the sustainability agenda cuts across everybody, particularly with the, the aftermath of the COVID-19 lockdown, the pandemic, and how the world is changing. We're seeing that the sustainability topic keeps coming up quite a lot. And I'll pass this on now to Eloho to talk about the sustainability agenda. And I know that the oil and gas industry gets a bad rap for sustainability. But can you share and when I talk about sustainability, it's wider than the environment alone. So we're also looking at workplace sustainability, we're looking at business continuity, we're also then looking at the social sustainability as well as economic sustainability. Because I know that quite a lot of time we think of it simply from a natural environment alone, which is important, but it's more than that. So Eloho, and I feel like Iriti already started that. Can you share how the sustainability agenda is driving change within your industry and some of what we can look forward to?
Sustainability agenda is definitely driving change today. So if we look at countries, we look at companies, you find that we are all setting goals towards achieving net zero emission by 2050, which is in line with the Paris Agreement. But just to give you a bit of flavor as to how we've felt the impact in our own industry. Globally, within the last 6 months, we have seen environmental, social, and governance investors, ESG investors, they've won board positions in IOCs. It's not something that we have encountered or seen before in the last couple of years. We've also heard of court rulings in Europe on climate change. We have seen some institutional investors pull out of oil and gas related investment. And there's several more. We could go on and on and on. We are feeling the impact. But however, if we step back, just like digitalization and technology, right? I believe that the transition to lower carbon future, we hold at different paces in different places. Our pace in Nigeria would not be the same pace in the Europe. Neither will it be the same pace in the US, because they are developed countries. We are developing. And the same thing will happen across various sectors of the economy. But what that does for us is it then creates new sets of risks, which we all have to deal with. But at the same time, it opens lots of opportunities, which we've all got to embrace. So let me take, for example, the Nigerian oil and gas sector. In Nigeria, we are blessed with abundance of natural gas. So our natural gas reserves, we have several reserves untapped today. So in Nigeria, we're seeing a renewed focus on our natural gas resources. We are seeing renewed focus in growth. Just recently, we took FID on Train 7 for LLNG. And that's mainly because natural gas is a lower carbon transition fuel. So you can clearly say that in Nigeria, we're also embracing the transition. natural gas emits between 45 to 55% less greenhouse gas emission, and it's less than the air pollutants that comes from coal. And we are looking forward to see us use more of that to generate electricity in Nigeria. So the focus is there, but the conversation now would now be on the pace and as to how we replicate some of the successes we've seen happen in other countries, which has put them in a higher or faster pace than we have. So that's something that we've got to really embrace in Nigeria and see how we make use of the opportunity of the decade of gas, which the government has declared, to help drive success in various parts of our economy in Nigeria today. Because if we do improve our electricity in Nigeria, just imagine how much that will do for our country, Nigeria.
Right, thank you, Eloho, and thank you for also sharing what is happening in terms of the move to gas and just how gas is also better for the environment in terms of the emissions, but then how that links directly to the bottom line as well as the social part of sustainability in terms of the people that will need to be trained to work, people that will be equipped to work, as well as the communities that will also be affected. And I'm going to come to you, Toye, now to talk a bit more about responsible business practices, because part of sustainability, right, is saying how does this, these sustainable development goals that you mentioned, the 17 of them, sometimes can seem a bit nebulous. How do we distill this into key business practices? How do we distill this into responsible business practices? And I know that in the investment and advisory industry, a lot of things have changed. Can you share some of how key responsible business practices are changing business for your sector?
Okay, thank you. I've been enjoying the conversations of my fellow panelists, and it's definitely an interesting, and I think it's never a wise thing to argue with the stronger side. So let me answer what you asked me. I think for me, and my view, that right now, any company, or any leader, or any CEO of any business, the first job is that of a risk manager. I believe every leader is now a risk manager. Risk never left, but is here with a bang. Risk arising from volatility, from everything, from people, from industry, from anything you can imagine. Sustainability, that we're all saying SDG goals 1 to 17, if you look at them at the basic, there are basic things that we've ignored for too long, that is now not just topical, we have to deal with. A long time ago, a very wise man called Elkington created a business model called 3 Ps, people, planet, and profit. It's not new, it's real. Each time one of those 3 P takes excess over the other, the problem happens that the universe complains. So for the last how many 100 years, we focus on profits at the expense of planets and people. Now the universe has complained with global warming and everything we are saying. Now we're now rushing again to try and fix the universe, global warming, carbon credits, telling Africa not to do energy anymore, fossil fuel is going. It's not going anywhere. For the next 100 years, even for the next 30 years, even price of crude is forecast to go over $200. In fact, beyond this year, but I agree with Shell that gas transition is an easier and a lower hanging fruit for us to get things done, where we are able to be better with the planet, but still solve our energy problem as a country. Because it's easier for developed world to say do renewables alone because of electricity, and we don't have. But they spent the last 100 years using that same fossil fuel to build their economies. So we have to look at what's cleaner, what's stronger, what's better on the planet. Again, gas gives us a chance for 3 Ps. We're able to make profits, take care of the planet, and build people. So for me first, one of the major changes is about the 3 Ps, people, planet, and profit. Now, at the core of that is what SDG is about. Whether it's water, whether it's healthcare, whether it's gender equality, it's about balancing, making sure capitalism has a conscience. You know, anybody right now, any company right now that ignores the social contract between companies and society you cannot have a business that's sustainable. You just cannot operate anymore. Gone are the days where you just see total profit maximization. One of our investments is called Atlantic International Petrochemical Resources in Bayelsa, Brass. Before we were building a refinery, a power plant, and other facilities in Brass, Bayelsa, Oklahoma, Brass. When we went there, before we started construction of this refinery that's going live next year, the first thing we did was to form a partnership with the community. Now remember, there's a major trust deficit here because this community had produced oil and gas for 50 years. They didn't have drinking water. The water was not drinking water. They had no decent hospital. The first thing we did as an investor, as an investment firm, as a responsible investor, but also that African was first build them hospitals, fix their water, so that they realize that we're not coming to ask or take before giving. Again, that has ensured the community has now partnered with us in terms of job creation, in terms of healthcare, in terms of water, in terms of everything. Those are SDG goals we first dealt with. Now, when we gave back to the people and the community, they rewarded us with loyalty, with no downtime to our business, to everything to support. What does that mean? Everybody right now needs to focus on what is sustainable. How can I ensure that my environment gets benefit beyond just talk? Companies must adopt practices that grow people, whether it is ensuring women participation in your business. Like I said, in our business as a platform, over 40% of our staff as women, and it's getting higher. We are able to focus on making at least 50% before end of next year. We have younger people. Back in the day, youth was a proxy for naivety of experience. No more. Young people are here with a clear statement saying experience is good, but the agility of youth, the innovation of youth matches experience as well. So I'm glad to hear Steve saying they're 200 years old and the Steve FinTech as partners putting that 3 years old. I mean, do you realize that there are about 3, 4, 5 fintechs in Nigeria today that are bigger than almost all the banks except 2 in just less than 3 to 5 years? What does that tell you? The youth and coupled with innovation, agility, and and drive, if he partners with the traditional banks, we have what we call tragility, traditional and agility into one. It becomes a thing, right? But together, we can all go together and win. So to just summarize the faces and arms that I'm talking about, it's about collaboration. It's very important. Nobody can solve the problem. Collaboration. It's about focusing on people, client, and profit in one. To summarize the SDG goals, or it's about trust capital, real trust capital with the environment, genuineness. For a long time, the buzzword was integrity. It's now evolved to authenticity. Companies must be authentic. They must be real. They must engage. They must be practical. Otherwise, the change that is coming is real. We have to adapt. And I see not just fintech continue to grow in health tech, in ed tech, in industry tech. Technology is no more an advantage. It's now the foundation. So you take the impact of technology, you take the focus on planet, people, and profit, you take collaboration, and put all these in African context. What you have is Africa of our dreams.
Right, okay. I mean, you've given us quite a lot to think about there. I just want to come back on something you've mentioned, which is in terms of the type of investments that your company goes into, that platform capital goes into, or advises investors to go into. And we share that it's important to consider people, planet, and profit. Would you say that it is time that the private equity and venture capital industry starts to also reflect on some of the ESG goals, ESG, which is looking at environmental, social, and corporate governance? What do you say to this?
But I think, thanks for that question. But to answer that question, that industry has always focused on ESG, right? I was in private equity for a long time, and one of the things that you do in due diligence is ESG due diligence, environmental, social, and governance due diligence. But you know what? That's interesting, because if you do the DD before you do an investment, what do you then do after the investment, right? It's about not just diligencing it, it's about monitoring it and implementing it. All that is good. What I'm now saying right now is, it's beyond just the private equity industry. It must be the banking industry. It must be the oil and gas industry. It must be entrepreneurs themselves. Entrepreneurship has a first mandate of taking care of the planet and people before profit. Profit will always come when you invest in sustainable practices, when you invest in people, when you create a conveyor belt of opportunities that continue to give. So while VCs and PEs have done that thanks to the DFIs who have ensured that happens, it now needs to come mainstream in almost every entrepreneurship. See, my view is we are placing too much emphasis on private equity and venture capital industry. They contribute less than 1% of investments in Africa. Let me give you that number. We have over 400 million micro SMEs on the continent. 400 million. Almost every other person in Africa is an entrepreneur. They're a trader, they're a tailor, they're selling something. But our challenge has been, how do we transit micro SMEs into main businesses? America has less than 30 MSMEs, but they have over 500 unicorns. We have over 400 million SMEs, we have just 9. You know why? The transition. People are not investing in sustainable processes, in systems, in things that ensure that they are sustainable. Now, how do we do that? It's capital formation. You know, I keep saying this, and the banks should not shoot me for this. In Africa, we somehow believe that bank savings are a lot less riskier than equity investments. And I laugh. How can inflation risk and valuation risk be a better risk than business risk? It's almost impossible. So until those of us here that have a lot of savings in our bank account start investing in entrepreneurship in a way where it is sustainable, we are then ensuring that our capital that we're investing in these small businesses, whether it's a fashion designer, whether it's an influencer, whether it's a mechanic, whether it's a food seller, helping them build sustainable businesses, keeping their books, paying their taxes, hiring right people, doing pension, doing healthcare, the ecosystem will not be sustainable itself. So for me, the VC are already doing that, but we should not take that as angel investors, as individual investors, and drive that entrepreneurship, innovation in a way that is sustainable. Sustainability cuts across everything from diligence to investment. We all need to do investment and partner with entrepreneurs to make sure that they focus on what is sustainable. It is that simple, and that's what I believe in genuinely.
Right, thank you for that. And I guess, again, it shows that there's quite a lot of work that needs to be done still in our environment. One, firstly, to adapt some of the sustainable development goals, as well as the governance goals and agenda, to adapt that to Africa. And we're doing some of that at Lagos Business School. We have our African Responsible Business Forum that seeks to see how organizations are trying to be responsible businesses, but also how they're adapting to some of the challenges in their context and their environment, so that we also know that developing Africa is good for business, but we need to make sure that, as Toye has mentioned, that we cannot simply copy and paste, but we need to ensure that we adapt this to our own environment. And I think that that's a good place to now start to look at some of the challenges that will come up in the future, right? Because as he said, there's quite a lot of change going on across the various economies, across various industries, across various sectors. And I'm going to come back to you, Eloho, to just talk about the oil and gas industry and to see what Shell is trying to do in terms of the next 5 years. Can we share some of what you anticipate to the change to be? And how do we also ensure that organizations in Nigeria are able to adapt some of the changes that you see, both in the oil and gas industry, but widely? So I know that Ireti has spoken about digitization, we've spoken about fintech, etc. But can you share some of the peculiar changes that you can anticipate?
Thank you. If we look at the upstream sector of the oil and gas industry, 5 years from now, we will definitely be seeing a more cleaner industry. And when I say cleaner, I talk about cleaner from the greenhouse gas emission standpoint. We would also be more cost efficient and more resilient. And that's where the transformational journey of digitalization and technology comes in. And we will definitely be playing a more larger role in driving sustainability in the society, because when we also talk about of sustainability, there's also the social aspect that comes with it, and clearly, if we then bring it back home to Nigeria, where we just the president just signed the PIA Act. That's the Petroleum Industry Act, where he just signed it. We hope to then begin to see more growth in the deep water business, specifically, because we haven't made significant investment in the last couple of years, and that's mainly tied to the uncertainties around the regulatory framework, the physical frameworks, and that definitely impacted the oil and gas industry in Nigeria. But if you then take it on to the rest of the society, and then you then think about our customers, our suppliers, you would see strategic partnerships begin to form, excellent strategic partnership, and you will then begin to see better collaboration among stakeholders, strategic partnership and collaboration are key levers that will definitely, every single business in Nigeria, every single one, we all need to embrace, because that's what will then begin to create opportunities for us. It will then help us to manage the uncertainties that come with various types of risk that we will begin to see in the next couple of years around us.
Thank you for that, Eloha. And I agree with you in terms of the need for more strategic partnerships, as well as better collaborations, as well as trust, which Toye also mentioned. We need to have more trust and to see that we have so many SMEs, and how do we start to create a lot more learning within the SMEs? How do we start to grow the SMEs? And there will be need for partnerships and collaborations to make this a reality. And so I'll move now from a sector focus to industry focus to more general themes that will affect business leaders. And I'll come back to you, Ireti, which is looking at the world that we are in now with COVID-19, which shows us that our development challenges are real and they're now amplified because in times of crisis, as well as the globalization that you mentioned, as our world becomes even more interconnected, these implications are felt deeper and they're also felt for much longer. How can business leaders respond to this in Nigeria? What would you say is the role of business in sustainable development?
I think it's good to think about the topic beyond COVID-19 and just sustainability in general, in terms of how businesses should respond. And one of the things that our CEO talks about is being a bank with a brain and a soul. And I think it harkens to what the doctor had said earlier in terms of having a conscience. So I think just general in terms of sustainability, I think about a couple of lenses. One of them is the 9 sustainability banking principles that the finance industry is holding themselves by. One of the areas there is gender representation, and with 8 bank CEOs of the 30-odd banks, I think that's something that the industry has done quite well on. There's also financial inclusion there, and there's also trying to impact positively the environment in which we serve. And one of the areas that the banking industry is looking at is trying to create capacity, especially for the youth. And so we've been involved in revamping National Theatre, creating an ecosystem for entrepreneurship, for innovation, for people who want to be involved in IT and fashion and the film industry as well. So that's one way in which we can be of assistance to try and revive the economy and support people. And of course, we know that our youth are the majority of the population. And from a city standpoint, one of the things that we have tried to do is to come up with a 2025 sustainability progress strategy. And those has 3 levers. One of them is sustainable operations, actually looking at ways to save to save fuel, to save waste, to save electricity, water as well, and to actually have a footprint, an environmental footprint that is responsible. Climate risk is another area, and just to help our clients to manage, to measure, and to reduce. And then the third area is the one that gets a lot of airplay, and that's low carbon transition. That's then providing financing to enable companies to transition, whether it's to gas, as the previous speaker had spoken from SNEPCO, which is less polluting, or to even just transition completely to new forms of energy. So green buildings, cleaner fuel, and sustainable agriculture and those kind of things. So financing is one way in which we can make the change. Thank you.
All right, thank you. And again, just to remind our audience that you are sending in questions, and I will open up for questions soon. But please send in your questions as well as the panelists that you would like to direct this to. Thank you for sharing that, Dimitri. And I would say that this again shows that the sustainable development agenda is not for one sector alone. We can see the impact of other sectors and how other sectors are interconnected. And this makes it even more important to go and look at how we can have better strategic partnerships and better collaboration so that we can achieve the goals. And now, Toye, you had mentioned that for businesses now, we need to look at the triple bottom line, people, planet, and profit. And that brings me neatly to this question, which is saying beyond profit, what is the imperative for change readiness that you see? And how do you also cascade this to your key stakeholders? Key stakeholders in this regard are your employees, your investors, and then your other stakeholders that you perhaps might think of, as well as the community at large.
So I think for me, one of the, and I'll keep saying this, is the definition of stakeholders that's very important. And I think covered it. I think for a while now, that stakeholder thing has become more of a buzzword, and because something more we talk about than we do. I'm not going to say to you there's a lot to change in terms of the concept of stakeholder management. I think the body of knowledge on that is well formed, whether it's your team, whether it's your clients, whether it's your regulator or the community. People have written a lot of books about that, right? That's not the problem. It is in execution and making sure and implementation. And I think that's what I keep saying. It is easy to do the things that are the things when it is not urgent. Do the important things when it's not urgent. Because if you have to do the important thing when it's urgent, it becomes crisis management. Okay? So first is everybody here knows what to do with the community. Everybody here knows what to do with your team or your clients or your shareholders. Do not let it be when you have your annual general meetings, you talk to your shareholders. Have an active, engaging relationship with your shareholders. Do not be when there's a crisis in the community and you have a community meeting. Have almost, if you are in a business where the community is very involved, have regular community engagement. Understand their need. Understand what they want from a partnership. It's not when you have issues with your team and high turnover that start reviewing salaries. It's about making sure that these things are done on an ongoing basis, making sure that these principles are embedded in your DNA. I've said this again, the change for leadership from leading or again from the front, which is very important, is now leaders should lead from behind. What does that mean? A leader is someone that sets the path, that charts the goal forward. Yes, you compensate. Yes, you lead from. But what a great leader should do is to stay behind the champion or the stars and pick after what they're missing after them. You know, that's what's very, very important. And for me, that is what it is. Leadership is about supporting the key part of your business, whether it's the team, the community, the investor, the regulator, or the community, staying and supporting and working with them, engaging them, communicating with them. And guess what? things will not always go right. Businesses will have problems. But the thing about it is communication and being authentic. I think authenticity in admitting we are wrong here, we messed up, how can we fix this? Having real conversations with people. People are willing to, you see, the thing that makes human beings special is the presence of hope, right? People will hope, because every day you wake up, you have to hope that it's a better day. But people just want to be authentic and be real with them. So, it's managing stakeholders, I would say communication, embedding the principles in the organization, and ensuring that even the leader himself sees himself as a servant. The concept of the leader-servant is now real, because a leader is not one that stays in front. He follows behind and makes sure that everything drops is picked, because either way, your head gets chopped anyway. So you must not just stay behind and pick up after. The great people do a great work. I think, again, the job of a great leader is to empower people and get out of their way. Let them do what they do very well. Whether it's in the community, if they are whether anywhere, get out of their way, set systems in place, embed stakeholder management principle in your system, in your communication, in your hiring, in your engagement, and then monitor, tweak, adjust, and balance as needed. So nothing new to say. It's just time we start doing stuff, real stuff, and talk less.
Right, I agree with you, but I also think it's important that we share as well, because when we share, we have the lessons that we can learn and we can adapt. And you mentioned, I mean, from what you've shared, for me, it seems that it's about having the right processes and the right structures within the organization, so that the various stakeholder engagement, meetings, coordination, enlightenment, sharing, etc., do not only happen at a certain time, but they are part of the organization's calendar throughout the year. And having processes and structure, I guess, is something that we need to also empower SMEs particularly to do better. And just talking about that, because Tony mentioned the need for that, even when we are working with our stakeholders, we can't simply be working from a crisis management perspective alone, right? And Eloho, this question is for you, because we hear that a lot of the time in leadership in Nigeria, the focus is really on the crisis management or even in firefighting mode, which looks at business leadership. Sorry, 1 second. It's about crisis management and moving from firefighting mode to having more strategic, responsible business leadership. Can you share more about how we can move from that? Because again, we hear that the pressures that face business leaders here are rising, the challenges are complex, and sometimes you really don't have that time to pause, reflect, and think of where do I want to go, how do I get there? Can you share what has worked for you and what other leaders can learn?
Going forward, every business would have to learn to deal with the uncertainties that come our way. And how are we going to be able to do that? We've got to ensure that the business strategy that we've got in place is robust. Not just robust, but it's flexible to be able to adapt to the various changes that we see coming. And one of the ways that would help us in ensuring that happens is that we must create that learning environment. We must embrace learning, and we must get input from everybody in that organization such that they can help in co-creating the long-term goals. Because at the end of the day, it's not just about the leaders delivering the goal. You need the people underneath to be able to deliver that goal. And for them to deliver that goal, they have to believe they have a part in that goal. They've got to own it, and they've got to focus on delivering it. And so one of the key things to do is to ensure that we have an enabling environment where people feel that, yes.
And I have to be careful to answer that question. But I'll quote somebody who, at least if I quote, I can't get in trouble, right? Warren Buffett. And he says the best businesses to invest in or to do are those businesses that have purchasing power, that have the ability to pass on purchasing power. Very important. Bottom price increases, which is purchasing power strength. What does that mean? Inflation is real. That's inflation in the US, everywhere inflation. So it's not in Nigeria. Maybe our inflation is higher, don't get me wrong. Or devaluation. But as an entrepreneur, as an investor, the focus should be on which business am I investing in, and that's the ability to pass on price increases. So let's first separate the policy or the macroeconomic framework of why price increase happens. That is not a conversation for 1 minute answer today. But to answer it from an investor point of view, entrepreneur point of view, look for business models that have the ability to pass on price increases. Look for something that people are willing to buy at any price, whether it's electricity or water or clothes or mobile phone or data. There are businesses that are almost fundamental to everyday survival. Those businesses have a way of being recession proof. That has changed over time. We'll change a bit more. That way, you're able to pass on price increases to consumers. And that way, you're able to then manage devaluation and inflation better. Whether it is a growing market share environment or competition, you are going to be fine if your business model is defensive enough and is strong enough to pass that price increase on. So again, pricing power ability is very important for any business or any investor.
I mean, it's quite a sensitive question, as you said, because the question is, who do you then pass it on to? Who does the individual or consumer then pass it on to? But that is beyond the theme for our conversation. The next question I would like to ask goes to Iriti, please. And it's saying that, how is the immigration of young, intelligent Nigerians to other countries affecting your staffing decisions, and what are your reactions to this?
Another difficult question, I think, to answer. We spoke
They're all difficult questions, by the way.
We spoke earlier on about globalization, and this is one of the dividends of globalization, that people's skills are portable, and they're portable across borders. And given that it's expensive to send people to school, to generate electricity, to live, I think young people are taking that they want to try a different environment and go somewhere where some of these things are a given and it's not as expensive. In terms of how it's affecting us, one of the advantages we have as a global organization is the fact that we encourage mobility. And so it's actually, if people are moving within the city family, it's not considered to be a negative thing. It's actually positive. I'm a beneficiary of that kind of mobility. I joined here 33 years ago, and I've come back now to become CEO, having worked in the UK and South Africa. So in the city context, we think of it as positive, as a way of allowing people to grow. But I think when I think of the broader environment, economy in Nigeria, and the fact that people there's a big brain drain, obviously it's a concern.
Right, thank you so much for that. And my final question is to Eloho, which is looking at Shell and the sincerity of the industry to development. We have about 1 minute left, so please.
So sorry, could you take that question again, please?
So the question is, BP came up with Beyond Petroleum many years ago, and Shell, people are wondering about the environmental credibility of the organization. There is cynicism about the industry's sincerity. What would you say to this?
Thanks for that question. And clearly, with climate change focus increasing in the world today, we have a situation where we've got that awareness growing in the world. So we've got to be able to match up to that awareness. And for us in Shell, sustainability means providing more cleaner energy solutions in a responsive interest. And for us to be able to do that, we must integrate the economic, environmental, and social consideration when we make decisions. So for the first time in the last couple of years, we've offered investors an advisory vote in our energy transition strategy. And that's because we want to be able to co-create with them. And that's not something that we have done over the years. So we are beginning to change our narrative, change our strategy to make it more inclusive. And with that, we do believe that a lot more people will begin to believe in the strategy that we have put in place. And that's when we talked about collaboration, co-creation. As long as we continue on that journey, I can tell you the narrative will change. It is changing. We're beginning to see the impact, but we do expect more change coming our way in the next couple of years.
Right. Thank you so much, Eloho. And this is a great place to spend. Very great conversation, many themes to think about, but also many lessons that we can learn and adapt to some of the organizations that we have here in our Nigerian business economy. Okay, so now I will pass on to Toye to give his closing remarks, as well as Ireti and Eloho. And your closing remark is just to talk about the one thing that you think a business leader should focus on for 2020 for our changing world. So Toye, over to you, please. Right, okay, I think Toye had to step away for a meeting. Like I said, our time is fast spent. So I will pass it back on to Ireti to share her final one thing a business leader should focus on.
Okay, I'm going to take some liberty here and wrap up 3 quick things. I think it's about being a trusted advisor, a trusted partner to clients, being responsible in delivering solutions and enabling economic progress. Thank you.
Right, thank you. Eloho?
Yeah, I like the fact that Ireti started off with being a trusted partner. There's nothing like that. I can tell you. So that's one thing that is really, really key for us. And then the second thing for us is ensuring that we create that enabling environment that allows everyone to play their role, be the customers, be the staff, be us as leaders. We ensure that everyone is collaborating together to drive our business forward.
Okay, thank you. Thank you so much, our panelists. And I'm sure that the audience and the attendees have really enjoyed this session. Thank you to our attendees for your questions, very thought-provoking questions. And so now I'll pass back on to Business Day. Ronnie, over to you.
Thank you very much, Dr. Okupe. Thank you to our panelists for that insightful session. Like you rightly said, business models are scaling fast, and we need to scale through with digitalization and technology. Right about now, we're going to be handing over to Mr. Chidi Okoro to take us through to the second panel discussion, New Perspectives for Corporate Strategy. But before we go to that, we're going to take a short 30-second message from our partners. Apologies to Mr. Chidi Okoro. We're taking about 5 minutes of your time. We will be starting your session in about a minute. We'll take a message now. Okay.
At the right time, but I think we all agree that the way we had been running business should have to change. You know, the way we derive and execute strategy certainly should be changing because the times are totally different. And I'm going to list a couple of things. And before I come to introduce the panelists, I'm going to try to list a couple of things that are, you know, driving the way we're going. And all of these turbulence, uncertainties actually reflect an income statement of organizations. So sometimes you wonder if we're going to be here, you know, how long organizations are going to be here. everything is changing, and I think we'll have a chance to look at that with a rich set of panel. One of the things we are thinking, we're believing, is that organizations will surely be rethinking their strategies to make sense of this uncertainty. We are grappling with a lot of situations, you know, and we never imagined that the consumer is more informed, they're value seeking, and of course, you know, they are reprioritizing repertoire of needs and products. Volatility in macroeconomics, we all agreed to that. The panelists would actually throw some more light on all of this. Devaluation, rising inflation, declining consumption power, access to Forex is a big issue over here. Cost hikes escalating, but you're not able to pass to consumer. These are some of the challenges we're facing. Supply chains are totally disrupted and scrambled, you know, both locally, globally. Digital and tech, transforming sectors, rising socio-political tensions, it's all over us. And then regulators are actually some of the issues we face. A lot of regulators are racing to catch up with changes in their own sector, and sometimes appearing as enforcers and revenue generating agencies. Imagine that. And of course, industry structures are changing and new competition from sometimes unimagined sources. And COVID has really come in to exacerbate all of that. So I'm going to shortly start to engage the panel, but I doubt our traditional approaches to strategic planning can lead us over the line. And I think business leaders agree to that. The approaches we adapted over time, and organizations are making decisions, and there are three choices we have, or maybe more. Some are making big bets and continue to chase opportunities. Some are actually hedging financial impact or any such adverse circumstance, and really moving in a different direction and waiting for things to blow over. Some are, you know, typically adopted a wait and see attitude. I think the big poser is how should organizations be facing the confusing realities of today and the medium to longer term scenarios, because it could get worse or it could get better, you never know. Surely delivering shared value desires a rethinking of our corporate strategy, you know, making sure that we deliver shared value. I think Dr. Adoni was speaking a bit to a shared value. Certainly companies are rethinking the way they derive strategy, the way they execute that. I think even the role of boards of directors may be changing in this regard. So joining me to discuss this, this will be, I will now go ahead to introduce the panelists. You know, we have the first one is Peju Adebayo. She comes with a great multi-sector exposure. Her profile has been shared, so I won't dwell on that. You know, over 3 decades of experience in various sectors. I mean, Peju has a very diverse experience. She's currently an advisory board member of the Lagos Business School. She's been through cement, building, construction, equipment, households. You know, an engineer by training. She's been in public sector as well. So Peju, you're welcome to this conversation. Peju, you're there, right? I saw you, Calvin.
Thank you so much, Chidi. Great to be here.
Great. Mustafa is also here. Mustafa, CEO, TAF Africa Global. Real estate is big deal. I think in Nigeria, we say we have shortfall of 17 million houses. We say that it happens at TAF Africa Global, one of the companies who lead us across the line. TAF operates in 8 African countries with dominance in Nigeria and Gambia. He was born in Gambia. He claims he's Gambian, but I think he's more Nigerian than Gambian. We claim him. Philanthropist of sorts. I think he really thrives on that. You have TAF Africa Leadership Academy, trying to help develop new set of leaders for Africa. TAF conference and networking, etc. Mustafa, you're welcome to this conversation. Mustafa, are you here? Hello? Mustafa?
Hi, yes, I'm Chidi. Thank you so much for having me. We're all going to have this problem of muting and unmuting.
Absolutely.
It's a pleasure to be here.
We appreciate that. Good. So, Kunle, a great friend of mine, Kunle Yelano, currently CEO, GlaxoSmithKline PLC. Major global pharma company with manufacturing and distribution. There are a few major global companies that have manufacturing and distribution operations in Nigeria or parts of Africa as much as GlaxoSmithKline. And Kunle's experience actually is quite vital because he's been across African markets and it's also been through parts of Asia, running commercial and building commercial operations. I think Kunle's experience and how the organization and industry is facing issues of redesigning, rethinking strategy in this uncertain time will be very vital. So Kunle, you're welcome to the conversation.
Thank you, JD. Thanks for having me. Good afternoon, everyone.
Good. For people joining in, if you want to send in questions, I think the link is there, www.com. Use the hashtag CEOF21. The other one is that you can chat in, right? I think we can chat in. I understand we can chat in as well. You can indicate the name of a panelist for which the question is meant. So I think what we're going to do is we're going to have an open conversation with the panel. They come with a rich experience. So we're going to have an open conversation and we'll walk through everyone. We're going to talk about today because the thing about strategy is that while you're figuring out the near term, the longer term may just be right by the corner. So we're going to start off with Peju. So we start off with you, and then we go around the panelists. And I think there'll be follow-on questions from there. If we do have any questions coming, we can also get that across to you. So the first question is, Peju, you've been across a lot of industries. How do you think organizations are making a sense of a current scenario as it relates to their corporate strategy? Are they hedging? Are they waiting to see or continuing to go for the opportunity? What are companies that what are organizations doing? We're going to come to talk about what will they be doing, but for now, what do you see companies doing? How are they getting around the turbulence and the uncertainty we see as it relates to their strategy? Go ahead, Pedro.
Okay, thank you very much for the question and comments. And as I said earlier, I'm glad to be here. So question is the glass half empty or half full? And I'm glad you talked about the short term and the long term. Because long term, we know that Nigeria is, not even long term, medium term, Nigeria is going to be the third most populous country in the world with populations greater than the United States of America. We know that we have a very high youth population, and we know that we're a high consuming nation. So the question for organizations is, how do we turn these opportunities into something which enables the organization to be sustainable and profitable? As CEOs and as members of the board, that is our responsibility, despite the short-term challenges. So it depends on what sector you're in. And as you said, I've crossed sectors. I would like to just highlight one sector, which is the renewable energy sector, energy more broadly, but renewable energy. So despite the turbulent times, 85 million Nigerians are without electricity. That's more than the population of many countries. And we have climate change, which is highlighting the need to move towards a lower carbon future. We have 22 million generators in Nigeria, again, more than the population of many countries. So it depends. So as some industries are definitely needing to redefine themselves, cut costs, embrace technology, look for new sets of consumers, other industries are thriving and there's a moment in the sun, forgive my pun. And so despite this very turbulent scenario, let's not forget that long term, Nigeria has a lot of opportunity to offer. Africa has a lot of opportunity to offer. The ACFTA has a lot of opportunity to offer. And we must be looking to see how we position our organizations to continue to take advantage of those opportunities. That's why we're CEOs. That's why we're members of the board. So I would love to talk about renewable energy in more detail, but I want my fellow panelists to have a chance to speak.
Yeah, thank you very much, Peju. I think we'll go to Mustafa. I mean, housing is a big deal, absolutely. Housing is massive. I think we'll have a shortfall of 17 million. That number never changes. How is your organization retooling their strategy, or how are organizations in that sector retooling their strategy to pick up this opportunity. As Peju was saying, the opportunity is immense. I think it's about facing up to the reality and trying to tap that opportunity. So what are you doing differently to see that you tap into that opportunity? Go ahead, Mustafa.
Thank you, Chidi. But let me just ask a question. When have we ever not tried to retool on what we're doing?
Absolutely.
I mean, and let's just first, I would like to put this into different segments in the corporate world. I mean, I am indigenous, I am Pan-African. I mean, I started this business. My strategy in doing business in Africa can be totally different from a corporate, or one of the corporate big entities like the IOCs. I am African, so, and I'll give you examples before I get into your answers, your question. I mean, I am Gambian, being Gambia with 2.2 million people. I came to Nigeria, a population of what, 200 million, almost. And in the middle of the Niger Delta, in Port Harcourt, and I defined all the odds. When I came into Nigeria in 2012, and I proved most of the bank managers wrong because they couldn't trust me, they couldn't see how I could survive. So I totally agree with Adebeju. You know, it depends on how you see the glass. I mean, whether you see it half full or half empty. And as an entrepreneur, as an African entrepreneur, I mean, our risk, our appetite for risk is much higher than others. So how I re-strategize, which is continuous. My strategy has been, starting in the Gambia, that I need to expand into Africa as a Pan-African operator. Let me focus more in Nigeria and the risks that I've gone through. Obviously, in 2013, when we came, 2012, Naira was at 160 Naira to the dollar. Today, as we speak, it's about 580, but we're still there. You know, we've almost delivered our target. We have survived 2 different governments, from a PDP or Amici-led government to a Wike-led government, and we're still there. So it can't be worse. I want to just go over, Chile, onto the current situation of the world, which is COVID-19. You know, when COVID-19 came in, almost the world was a standstill. But for me, honestly, as an entrepreneur, I knew that it was very short because we were totally affected. The whole globe was affected. I mean, the West was affected more than us. Actually, it was thought that probably we'll be seeing Africans dying in the street, and they are shocked on how we survived it. But that tells us how resilient we are to all these crises. So for me, the way I see it as an indigenous African CEO is to always work on calculated risk. To be more specific in my business style, I am into housing development. Nigeria, as you said, the deficit, since I came in 2012, that figure of 17 million has never moved. 17 million. So most likely, if it was in 2012 and the population growth of about 3% or so per annum, now it's over 20-something million deficit. So again, great opportunity. For me, that's what I see. Great opportunity for housing in Nigeria. And not to talk of West Africa. So for me, this is the way I see our business, our corporate strategy. It's continuous, it's not just now, and it will be here forever. Africa has great opportunities, huge risk. I will give you a good example. I was in Guinea about 2 months ago and signed up almost with the government. We woke up 3 days ago, well, 3 weeks ago or so, or a month ago, and there's no government anymore.
That's right.
That will stop me from moving on. And that is why I hedge my risk by looking at multi-countries. And you know, I can go more into detail, so let me allow the other panelists to come in. But my strategy is really to hedge my risk, and I see my role as an indigenous CEO quite different from where the other bigger corporate CEOs are coming from.
Thanks a lot, Mustafa. So you believe in dynamism. You certainly believe and thrive in dynamism of that strategy that your organization employs, but you're focusing on the big opportunity of managing the risk within that. So let's come over to Kunle. I think Mustafa did mention that he's African indigenous. Kunle works for a company that is probably in the 204 countries of the world. I can imagine, where you sit. And I think you've been across Africa and the world as well. Strategy is about choice making. And the company you work for got a lot of choices to make. How are we seeing these choices within the organization and industry in general? You work in an industry that is on the up right now. So we think, the pharma industry, certainly. So how are we making these choices about where to play and how we're going to win? I mean, about today, we're focusing on just today. What's happening? New molecules, new markets, etc. What's going on in the organization and your industry? Go ahead, Kunle.
Thank you very much, Chidi, and great to be here. Like you said, we've been around for about 300 years, and we're present in over 200 countries in the world. And to the point you made, indeed, if you look at strategy, we probably can look at it simply as a plan of action for us to achieve our objectives in the medium and long term, to achieve our overall aims, right? And an important element of that, of course, is making trade-offs, making the right choices of where we want to play, and probably more importantly, where we don't want to play. And to some of the points that have been made by both Mustafa and Adequiju in the last couple of years, 18 months, 2 years, we're in a brand new world, right? The world has indeed changed. It's not the world we woke up to at the beginning of 2020 that we were still at. And it has what you call the turbulence, right? Instability. It's always been there, but it's probably been more heightened, especially in Nigeria. But to the point that in every situation of turbulence, in every situation where things appear unstable, you always find two things. You'll find opportunities, and of course, you also would find risks. So it depends really upon the strategic choices you want to make, whether you want to play by hedging those risks or by making sure that you take decisions to unlock those opportunities. And in truth, for it's a leader of industry, for a CEO to look at it, one of the things you need to do to know what you would play out, whether to minimize your risks or unlock the opportunities, or both most of the time, is to examine your entire value chain, right from the input into whatever you're doing to your customers. Look at your entire scope of strategic activities, your customers, your competition, the market, your channels. And of course, look at your people and decide what needs to change. And I think that's a pretty important thing that we all need to be conscious of when we run businesses. You need to have the appropriate balance of making to have that balance that I mentioned between how do you want to run the business and how do you change the business. And you probably need to do both simultaneously. So for instance, one of the things that happened, if I take my mind back to last year, was when the world changed, was how we decided to play. Right from the onset, we had decided, based on our position in the industry, especially in Nigeria, where we have the leading multinational pharma company in Nigeria, we had decided to be a part of the solution right from the onset of the pandemic, right? So of course, being part of the solution entailed a number of things. We need to make sure that we had we needed to have business continuity. We need to support frontline healthcare workers. We need to do a number of things to make sure that our medicines, our consumer healthcare products keep being available. So one of the choices we made last year was to change our route to market. There were a number of strategic choices that we could have taken, but we thought the one that probably would give us the biggest bang for the buck, so to speak, was to take a look and tweak our route to market to make sure that in that complex world where virtually everything was shutting down, people still had the opportunity to get these medicines, to get the consumer care products at the dial of a button. And it wasn't looking at how the world was then, it wasn't as straightforward as probably sounds. But we made that choice. And I can tell you that if we look at some aspect of our business, that single choice of tweaking our route to market has probably what has resulted in as of the time we published our quarter results for one of the sides of our business, probably an upward of 20% growth versus same time last year. And that speaks to making the right choices, even under uncertainty. And we could go, I'm sure as we go along the discussion, we'll look at other things, how different parts of the businesses have contributed to that, and what more will still be done from a broad perspective for businesses. One of the things I need to point out is that from what we know, from what probably every CEO on this call knows, there's a need for businesses to reset their DNA. In line with what is happening. And resetting your DNA probably has to do with two things. You need to reset your strategy, and you need to reset the culture of your organization. I'll be interested as we go along, for us to examine this.
Good, thank you very much, Kunle. I think we picked a couple of points there. You spoke about, you spoke a lot about, looking at the DNA. That's where you landed. That's a great place. Let's continue with you briefly. Were there trade-offs that you have? Your company is making, or people or players in the industry are making, and do you have advice for other industries or other companies, maybe not in your space, to start to think about trade-offs that they have to make? Because for strategy to be right, there might be trade-offs that you have to make. Are there some trade-offs that you have made as a CEO yourself or your organization is making? Kunle, we'll continue with you, and then we'll come back.
Absolutely, Chidi. Strategy is all about making choices, and there would be, for you to know that you have a good strategy, you must have made a trade-off, because you really can't do everything at the same time. If you're doing everything you want to do, you are probably not making the right choices. An example, I'll speak generically for obvious reasons. I just mentioned the tweaking that we had to do with our supply chain. There were many opportunities that we saw within the instability, within the crisis that came upon the world. For example, we saw the opportunity of new product launches. We saw the opportunity of making sure that we work on some other segments of the market, and of course, we saw a bit of opportunity, some opportunity in route to market. Knowing the constraints that the market faced last year and is still continuing to face, we've spoken, for instance, of inflation. We've spoken of the instance of devaluation. We've spoken of high unemployment. Our people's out-of-pocket expenses being constrained. We have to take a critical look at it and say, of all these choices, if we're to execute well, and by the way, strategy at the end of the day will all be about execution. That's what will make a difference, right? If we're to execute well, which one will give us the big advantage? Which one do we have the longest runway to make sure that we achieve what we want to achieve in line with our overarching ambition? And of course, we settled on what we thought was the right decision. And from the results we have, year to date, from last year, I would want to believe that we made the right trade-offs. Some people might see from a different perspective, but the fact is that we made that trade-off doesn't mean that we still won't come back to the other options for us to execute them, right? But we need to understand that we can't do everything. Resources are always limited, especially at this time. So again, it's all about making the right choices at the right time and executing very well on what to take a decision on the trade-offs we made.
Thanks a lot, Kunle. So we'll come back to Okpeju. Okpeju, you're on the board of a couple of organizations. You've been, even public sector. You have the single honor of being in public, private, large organizations, private organizations. I think we're going to talk about the boards now. Do you think in terms of strategy, design, relook, rethinking, that the role of the boards should be changing? And if so, how and why should it be changing, or why and how, rather?
Okay, thank you, Chidi. I think the role of the board... Are you
here?
Yes, I am here.
Hello, Okpeju.
Can you hear me? Hello? Hello? Hello?
Please go ahead, we can hear you.
Okay, I think Chidi dropped off.
Yes, I guess.
Come back.
I think you can go ahead, Mr. Dibajo.
Okay. All right. I think the role of the board is especially critical at this time. We're going through a very turbulent period, and at different times of disruption, sometimes the CEO takes the lead, sometimes the chairman takes the lead. I think this is a time where it calls for strong leadership and coherence between the chairman and the rest of the members of the board. The environment is changing, and the role of the board is to steward the organization through turbulent times. It's very important now that boards are listening. I think it was Kunle that talked about what customers are doing, how they're using the products, and how they're getting the products, because you talked about the route to market. So at this point in time, listening and even not all trends are going to be predictable. So the board has a number of steps to take. I think the first is awareness of what's going on, being able to pick on the current trends and being able to even anticipate future trends, which calls for listening, which calls, for example, more regular environmental scanning, which talks for taking part in sessions like this, which talks for learning, which talks for knowing what's going on all around the world. And if you weren't doing it before, the training and awareness and education of board members is more critical than ever, because many board members may not, for example, have experienced or even understood the implications of some of the trends. Two very obvious ones are the digital transformation that we talked about, and that is completely revolutionizing industries. Some companies will not exist if they don't digitally transform yesterday. And COVID has actually accelerated the pace of adoption of technology and digital transformation. So if board members are not aware of what's going on and how to respond, the organization can be doing business as usual and doing it very well, but a complete tsunami comes and overtakes the industry and they no longer exist. So a good example is what's happening with financial institutions and fintech and telecoms and companies like Amazon. Those companies can easily now begin to do what banks are doing. And so every bank board, I'm using that as an example, must really be thinking about what are the implications of this revolution to our business and how can we embrace digital transformation. In Lumos, for example, that's the company I was in previously. One of the things that we did during COVID was to use digital transformation to use other people's payments platforms to enable us continue making payments, to enable our customers continue making payments when our regular payment channels were shut. So that awareness of what's going on in terms of technology, in terms of ESG and climate change, asking questions, and saying what is the implication of this for our business is absolutely paramount. The other thing that the boards need to do is ensure that even in terms of board composition, and many of these things are prescribed in the Code of Corporate Governance. And we all look at it and we say, yes. But looking at board composition now, especially given this turbulent change, does the board have the right skills to understand and weather the change? What is the role of technology on the board? Do we need to bring in particular skills onto the board? What is the role of diversity in the board? Are the voices being heard in the board reflective of society and what's going on with our consumers? After all, at the end of the day, it's our consumers that buy our products or services. So there are many, many critical things that boards need to be doing to ensure that they are totally on top of this turbulence. To name a few, the first is complete awareness of what's going on, however you need to do it, making sure that you are hearing, you are listening, and you're understanding the implications for your company. The second is looking at the composition of the board and ensuring that you have the right skills on board. For something like technology, I think boards also need to be going out more and not just waiting once a quarter or once every 2 months for board meetings. Boards need to be also out about. If you have factories, your board members need to be visiting factories, sites, understanding and hearing firsthand what's going on with employees and what's going on with customers. Because sometimes the only way the board is really going to understand is to ensure that they're hearing directly from customers. The last I would say, two more, and I'll let others speak, is board evaluation. It's important that boards also are able to evaluate their own effectiveness as a board. The Code of Corporate Governance prescribes that it's done every year. I don't know how many companies actually do that, but for the board to be able to get feedback on how effective it is important. And the last I would say is that since we cannot know everything, there's a role for bringing in trusted advisors, as in bringing in the professionals, bringing in consulting organizations, bringing in external expertise to talk to the board and enable that the board understands what is going on and how to respond. So we shouldn't be shy as a board. And I think the role of the chairman there is critically important. Number one, to ensure that the board is aware of the changes and the implications for the company. Number two, to look at the skills and composition in the board and ensure that it's right for our times. Number three, board needs to get out there and speak to employees, speak to customers, understand what is going on. Number four, boards also need to bring in trusted advisors to ensure that they're being well advised. And number five is boards need to evaluate themselves. And then there's a number six, communicate. It's not enough to just have a page in the annual report saying this is what we're doing. The board needs to ensure that the company has very effective communications so that all our stakeholders, we talked about stakeholders earlier on, are bought into and sold into the company's strategy.
Well done. Thank you very much. I think that's extensive about the board. I mean, you're talking about more involvement by members of the board, but they have to have the capability to contribute positively. So we'll come back to Mustafa. I think I kind of like the idea of a positive psychology tilt to strategy development and evolution. I mean, you talk about remain positive, go for the opportunity. That's great. How does a CEO remain positive in the midst of all of the turbulence and everything? You have VUCA, volatility, everything is all here. It's happening. You're struggling to, Kunle will tell you he struggles to get his raw material. Kunle is probably a clearing agent and CEO, and also probably a customs expert or something, excise expert. You also do have the issue of Nigeria. Nigeria on its own, it's another case. And you do have COVID compounding all of it, and then Africa and the world in there. How does a CEO keep that positive stance to really focus, to design the right strategy that keeps it focused on picking up opportunities available in your sector? Can you share some experience with us? Mustafa. It looks like you're muted. It looks like you're muted, Mustafa.
Yes, okay, I'm unmuted. Now, again, thanks, Chidi. Chidi, let me first tell you that, as a CEO, you are a leader.
Absolutely.
And a leader needs to have certain values of leadership. And that is why you are at the very top. And there are certain values that a leader must have. I would not waste your time by just listing out those leaders. And that's what keeps, that is what should keep a CEO positive.
Mm-hmm.
But as you go quickly on the list, innovation. As a corporate, as a CEO, you need to be innovative. You need to be persistent. Whilst all these issues that you are having with challenges, there's a need, to be persistent, to be perseverant. So these are all some of the values, few of them that you need to do to keep in top, to keep on top. Now, for me, again, let me focus on my strategy as a CEO in these turbulent times. We obviously have both our medium and long-term strategies. For the long term, we have realized that Africa has got a very youthful population, very youthful. So I believe that any corporate body that works without incorporating the youth into your corporate strategy, you're lacking behind. So at my management level, my average age is 30 years. So I'm building for tomorrow.
That's good.
So obviously, I'm 65 and started a business. So what I tell people in a very, it's a little bit of humor, is that I clone my staff. So if I couldn't make it today, Lucky, who you've been dealing with,
yeah.
Lucky is a replica, is almost being a replica of myself. And this is what I am looking at my staff being very young, that look, I need to retire very soon, I need to step out. But what happened mostly in African corporate bodies is that businesses die with the original owner. But in our case, that we don't think that's going to happen. Across countries, we have set up, young people, very young, who believes in the corporate strategy, both in the medium and long term. So we invest a lot on them. We train. We invest a lot on training. We're also very much technology savvy. Most of our business is cloud-based. So when you require anything from me, whilst I am in the Gambia, Lucky in Nigeria can easily pick it up. And anybody can access it. I have a member of staff who is in Malta now. He's studying in Malta. We handle all our social media pages. So that's how I survive as, and again, I keep on underlining this indigenous corporate CEO, but also as a founder. Remember, this is a business that I founded, 31 years ago, all by myself, that has now grown beyond borders. So on the medium and long term, training is key. Partnership is also key. And again, let's look at the political risk that we all go through. Because in Africa, the biggest risk, one of the biggest risks is political. In the type of business we do, we are looking at delivering 1 million homes over the next 20 years. And we are sure that every 4 years, a government will change one way or the other. That's right. Maximum is 8 years. If you have a PDP president coming in or an APC president, the maximum he will serve is only 8 years, 2 terms. If he's unlucky, it's only 4 years. And look at the frequency of even governors changing, ministers changing, special advisors changing. And we know that in Africa, basically most of the time, anytime that a government changes, the whole policy at times changes. So this is a huge risk. So we hedge on this, we manage it, we develop relationships, making sure that relationships are kept so that it's continuous. That continuity is key. And this is a mistake that some CEOs do make. They focus on the individual who is in office at the specific time. And again, typically the reason why, and I want to underline this, the reason why we could survive from one party to the other, from one governor to the other, meant that everything that we did was above board. So that is key. And then we are looking at our legacy. I mean, I think, again, very African, one needs to look at your legacy. What do you want to be remembered for? What do you want to leave behind? It is not the zeros and the numbers, the amount of money we leave in our bank accounts. But we want to be seen, for example, for me, I am here, but thinking maybe in the next 30 years or 40 years when I'm no more. How do I want to be in deep there, but still know that I left a legacy behind? So as African CEOs, we need to think about legacy. It's not only the amount of buildings we have or the amount of money or the private jets we fly, but what have we left behind? And that can only be done, by encouraging and investing in a youthful population. That is why, again, we've set up a foundation very quickly, and our foundation, 1% of our revenue is committed on our foundation. We do the Tough Leadership Academy. When I first started in the Gambia, the first cohort was only 50 university graduates. And then the second cohort came at 300. We are on the third cohort, is 1,600. And what I do is at times I walk into offices and I am pleasantly surprised. A young person walks to me, Mr. Taff, you remember me, you don't know me. I say, I'm one part of your cohorts. That is a pleasure. And these are the things that African CEOs must do. We must look at our legacy. What is it that we will not be remembered for? Thirdly, so I can give my fellow panelists some time, is to be part of the global solutions. Because we know that some problems are global. For example, the lack of housing. That is why we concentrate on delivering affordable housing, affordable and social housing. A lot of people do ask me, for example, in Nigeria, why don't you come to Lagos? That's where the money is. But that's not what I'm focusing on. Why don't you come to Abuja? And we've proven a point. We've proven a point that we went to Port Harcourt, in a massive land and delivered 1,200 houses that works. The waiting list on renting a property in our development in Port Harcourt is 2 months. If you wanted an apartment now, you cannot have it because everything functions. Because we focused on solving housing in Nigeria. Security. You can have your kids riding their bicycles around the estate. You have your power. You don't know, it's illegal to own a generator in that estate.
That's good.
So it functions. So these are some of the few things. I can go, on and on.
Good.
But we want to be part of the solutions of the global problems.
Brilliant. I like that, Mustafa. I think it's something for everyone to take away, which is about that positive psychology approach to strategy development, believing that as a possibility. But one thing you said that's instructive is that I think you preempt the challenges, you preempt the environment. So you build your scenarios based on what may go wrong or what may go right. So I think that keeps you ahead of the curve. So you're actually ready with a solution for when the issues arise. So I think we'll take questions as we go. We'll have one question, and I think it speaks about granite, and I know one person or two people out of the three, they dealt with granite a lot. I know my sister has been involved with granite a lot. So the more things change, the more they remain the same. What elements of strategy are granite hard and will probably never change? I think, Peju, you want to speak to this, and we're going to come to Kunle next on this. What elements of the strategy will not change? They are granite hard, they never change.
Very, very good question. Can I say that the most important thing for me is execution? You can have brilliant strategy, but if you can't execute, you're dead. So you need to have and it could be, I think, first of all, the best strategies are usually the most simple. What they say, you can explain to a 4 or 5 year old in the lift the most obvious, and you have to have the ability to execute, communicate. Human beings are the ones who deliver strategy at the end of the day, not equipment or machines.
Brilliant. I love that, because the company that execute are ultimately the ones that win, right? The ones that win big. So Kunle, your perspective on this, what elements of strategy, if you look at your industry, the big farmer and the small farmer, that's the big farmer and the small farmer and the regular farmer, which elements of the strategy never really change in your world?
I'll step back a bit to respond to that question, and I think it's a brilliant question. And something should never change in reality. We do need to remember that we're developing a strategy for a particular reason, and that reason is the why. Why are we developing the strategy? And the why is what should not change. And that why generally is what we call purpose. For what purpose does that business exist? Why are you doing what you're doing on a daily basis? What inspires you? What motivates you? We need to kind of nail that down as an anchor that is immovable. In our instance, for instance, we want to positively impact the lives of 200 million Nigerians on a daily basis where we can. Whatever strategy we develop is to achieve that purpose. Whatever execution is to deliver on that strategy. And in reality, one of the things that will help all of us is to always reorientate ourselves around the purpose. Why are we in business? Why are we doing what we're doing? And when things get topsy-turvy, as they usually would be, we need to remember that the best way, I think it was Peter Drucker that said that the best way to create a future is to create it. And that goes back to the purpose of what future are we trying to create? Why are we doing what we're doing?
Good. Thank you very much. I think we start, go ahead. You have some more comments. So we start to wind down. Our time is getting out. Another question. This is for Mustafa. In a market like real estate, the demand is there, but issues of cost escalation and customers cannot afford. How much flexibility does one have to change strategy if you keep delivering new homes? I'm sure it means if you have to keep delivering new homes that are affordable, how much flexibility do you have? And then we'll come around to take your final thoughts, and then we'll wind down and hand over to the next group. So Mustafa, please.
Let me just tell you, am I muted again? No, I'm not. Okay. No, let me tell you quickly, let's define affordable homes. It's the buzzword today. And every time I'm in such, people ask me, but let's define what is affordable home. See, an affordable home is anything that anybody can afford. So if Chidi can afford $1 million home, that's what's affordable to you. If Kunle can afford a $30,000 home, that's what's affordable to him. So there will always be a market, there will always be buyers for any product that you put in the market. It's just like cars. Some people are on Keke Moto, others are on Rolls Royce. And we focus on affordable home. We have a bracket, and our bracket is also dollarized. So I've heard people in Nigeria, for example, every time you come there, they say, oh no, we need to deliver, especially for government, we need to deliver, homes at 4 million naira or 5 million naira. It's impossible. I mean, as we all know, just this past month, look at the value that naira has just lost. So really, I think there'll always be demand, and I want to stick. And because I'm Pan-African, I have pegged my prices within a bracket, and the type of houses that we deliver, we look at an average of about $40,000. And anything below that, it's impossible. For me, it's impossible, and that's the market we're targeting. I tell people all the time that, look, I'm not driving a Keke Moto or selling Keke Moto. I am more looking at a Toyota, but not a Land Cruiser, or so, but I'm looking at something that is affordable. And that's for the middle class. That's our target. There will always be a middle class that one way or the other will buy. The only thing that is coming up very quickly, and we have succeeded in doing in the Gambia, is to get to engage banks to issue out mortgages. Banks in the Gambia are now issuing out mortgages, at single interest rate, single digit. Obviously, because we target, diasporans, many Africans are living in diaspora. They are dying to get homes. They can afford foreign currency, so we give them single digit. And then local currency in the Gambia, we are issuing 13%. So there are ways of doing this. As I said, we must look at this holistically. We must look at the global problems. Nigeria, housing prices can come down where we access affordable mortgages. We need to partner with multilaterals that can bring out affordable financing so that the offtake can be able to pay for these houses.
Brilliant. Thanks a lot, Mustafa. We're going to now take your final comment. Let's take 60 seconds to say that, but Kweju, while you make your final comments on, how do we adapt strategy in these uncertain times, your final comment, but someone wants to know, is strategy a meaningful concept in public service? You've been through public, private, you've been through a lot of organizations, by the way. So is it meaningful? And then your final thoughts. Please go ahead.
Strategy is an absolutely meaningful concept in public service. It's the same thing. You have a CEO of a country, you have a CEO of a parastatal, you have a CEO of a ministry, a CEO of a local government, who also has a board of directors. How supportive is that board of directors? And the CEO, just like us, has to deal with so many stakeholders. Perhaps in the case of the public sector, the stakeholders are so much more multifaceted. And when you look at profits versus purpose, you're talking about purpose and talking about social impact becomes more important than the issue of profits. And actually, that's a good point for me to segue my final comment. We're all leaders on this call, and we are CEOs. We're leaders of our organizations. I believe the elites in Nigeria have failed the country, and we must begin to derive a consensus on government and the way we should go. I think it's incumbent on all of us to enable our employees in our organizations and the stakeholders to get involved by going out to get their PVCs and voting. Because otherwise, as they say, you get the leaders you deserve. So I want to engender all of us to ensure that we're not talking about taking sides and joining a political party. But if you don't vote, as Mustafa said, every 4 years, there's constant disruption by changes in government, changes in policy. Go out there, get your PVC and be part of the solution. Don't sit on the sidelines and complain about the problem.
Good, thank you very much. So we'll come to Mustafa. Someone wants to get your contact, is into furnishing or furniture company, wants you to mentor. I think the organizers will get link both of you, but your final thought, how should we be approaching strategy in these turbulent and very uncertain times? Just your final thoughts on that.
I like my humor, and this is why I'm proudly Nigerian. You see, absolutely. Nigerians now, somebody wants my contract to make business. But I just want to bring my indigeneity in all this. Strategy is very important. But again, let me just derail, not to focus too much on corporate strategy and so on. Opportunities that I see in countries like Nigeria. As Adepeju said, we need to take control, but again, focusing on the youth. In every African country, over 60% of its population are below the ages of between 25 and 35. So we need to focus on them. And as corporate leaders, we need to take up our social responsibilities. We saw what happened in Lagos, some time ago in Nigeria with NSAS. It's a time bomb for Africa. It is our responsibility. Let's empower this youth. It's not only in Nigeria, in Senegal, some political upheaval happened, and they were on the rampage. We saw what happened with the Arab Spring. So it is a time bomb. Let us face reality. We need to take up our social responsibilities to make sure that these youth are engaged. They need to be engaged. We must not always think about profit that is required by our shareholders, but let us also understand that we can only be in business if we take up our social responsibilities.
Thank you very much, Mustafa. Finally, Kunle, your final thoughts on corporate strategy in these uncertain times. Finally,
thank you, Chidi, and I'm glad you mentioned certain times. Indeed, we live in a volatile, uncertain, complex, and ambiguous environment. And truth be told, it will remain like that for some time. It's not going to change and become stable anytime soon. Having said that, we need to realize and remember that despite that environment we're in, which is a classic VUCA, right? There are organizations that actually are thriving in Nigeria and actually doing extremely well, while many others are falling by the wayside, which tells me in reality that it's probably not your environment that determines your outcome, right? It's how you respond or how you adapt to your environment that's what's going to determine your outcome. And what do you do to adapt to the environment, to respond to it? Adjust your strategy, adjust your culture. And that's probably what will determine your outcome. That's why you might be able to try. And in doing that, those adjustments, those resetting, always have an opportunity mindset. Where's the opportunity? What do you need to change? What do you need to start? What do you need to stop? What do you need to accelerate? And that's ultimately what will determine your outcome in the midst of the environment where we're in. Thank you very much.
Thank you very much. Thanks a lot, Adepeju. Thank you for being here with us. Mustafa, really appreciate that. Kunle, wonderful to have you here. We picked up a lot of buzzwords from here, but dynamism is critical. Purpose is critical. Your DNA is critical for staying focused to delivering shared value. Wonderful. So I'll be handing over to Frank Ibogun, the CEO, publisher, BusinessDay, to continue with the next session. Frank, over to you.
Thank you very much, Chidi. And let me also express appreciation to your panelists, Mustafa, Beju, and of course, Kunle. Chidi, I hope you all will be staying to listen to our guest speaker this afternoon.
Absolutely.
Our guest speaker is Dr. Michael Raynor. Easily one of the world's leading thinkers on strategy, innovation, and uncertainty. When he published his book, The Innovator's Manifesto, the Financial Times called him one of the most articulate and interesting of strategists. Michael is the author of The Innovator's Solution, creating something successful, creating and sustaining successful growth, which he co-authored with Clayton Christensen. He's also the author of The Strategy Paradox, Why Committing to Success Leads to Failure and What to do about it. As I said earlier, Michael is the author of the Innovators Manifesto. Michael has also authored the 3 rules, how exceptional companies think. And he co-authored that with Mumtaz Ahmed. Recognized as one of the most articulate and interesting thought leaders in innovation, Dr. Raynor brings a uniquely data-driven approach to the development and implementation of cutting-edge concepts. Raynor also contributes extensively to several publications, including the Harvard Business Review, Strategy Management Journal, Strategy Plus Leadership, and is a regular columnist for the Conference Board Review. A director at Deloitte Services LP and the innovation team leader for the firm's eminence function, Dr. Raynor is also an advisor to senior executives in many of the world's leading corporations across a wide range of industries, focusing on questions of strategy and innovation. Dr. Raynor has taught in the MBA and executive education programs at the Richard Ivey School of Business at the University of Western Ontario in London, Canada, and also at IMD Business School in Lausanne, Switzerland. Dr. Raynor holds a doctorate from the Harvard Business School, a master's degree in business administration from the Ivey School of Business at the University of Western Ontario in London, Canada, and on an undergraduate degree in philosophy from Harvard Business School. Dr. Raynor is a Canadian, and I believe he's joining us today from home. It is indeed a great pleasure and privilege to say that at my first participation in the World Economic Forum in Davos, I was handed, and I think I was fortunate, I was handed a copy of your book, The Strategy Paradox. I have read it several times and I've had to read it again in the past week preparing for today.
My condolences.
It is certainly, it says in a place in my my shelf that is so easily reachable. I frequently just do like this and I pick it to read it. I am so grateful, and it's such an honor to introduce you and to listen to you this afternoon. Over to you, Dr. Raynor.
No, thank you very much for that extraordinarily warm and kind introduction, Frank. That's very gracious. I can't wait to see what I have to say. I sound like I might be interesting. Although I will warn everyone, as my wife often points out, the key to happiness is low expectations, which explains our 30-year relationship. So this will go better if we keep that in mind. I'm enormously grateful for the opportunity to share with you what I've been working on really for my entire career. As Frank mentioned, one of the books I've done is the 3 Rules, and that came out in 2013. Now that's my most recent book. That's already 7 years old. As the Danish philosopher put it, Sorensen put it, life is lived forwards but understood backwards. And looking back now on the last 20 plus years of research consulting and trying to write down what I think I've learned, it started finally to make some coherent sense to me. So I will share with you over the next 30, 40 minutes how I think the different threads of the work that I've done kind of weave together and create something that I hope will be greater than the whole. I'll look for a thumbs up from someone to let me know if you can see those slides properly. If that's rendering, oh, we're good, excellent. So I'm going to put that now into slideshow mode, and you're seeing the slides. Excellent, okay, terrific. So as you may have inferred from the titles of the books, right, the Innovator's Solution, Innovator's Manifesto, the strategy paradox, and so forth. There are a number of different concepts that feature. And the first of these, I think, is strategy. And somewhat ironically, that's the last book that I wrote, right? So I ended in some sense where I feel, frankly, I should have begun, which was with a deeper understanding of strategy. A complementary construct, of course, well, not of course, but a complementary construct for me to strategy, something that's very different, but indispensable, is innovation, which of course is where I began, but that should have come second. And I should have finished with what I did in the middle, which was an understanding of uncertainty. And the shape you see here is known as a Mobius strip. It's said to be a shape with one side, which is of course a metaphor, but it's I think a helpful one. And the subtitle here I've taken from Douglas Hofstadter's 1977 book, Gödel, Escher, Bach, An Eternal Golden Braid. So three constructs that are quite different, highly complementary, and in some cases, fundamentally inseparable. And so what I'd like to do over the next 30 minutes or so is offer to you how I've come to think about each of these concepts individually and collectively. The examples, simply as a consequence of where I've spent my entire career, are drawn exclusively from North American business. And I won't pretend that generalizes either across time or across geographic areas. So I'll offer all of this really for your consideration. You may conclude that some of what I have to share here is directly relevant, almost as is. Some of it may be useful with varying degrees of customization or tailoring for specific and different circumstances. And you may find that some of it is actually not relevant. And that's okay too. I won't take that personally. But if I might, if you'll permit me, I'll give each of you a job, if you will, which is, as we go through this, reflect on that question about the extent to which these concepts are directly applicable, applicable with modification, if you will, and perhaps simply not particularly relevant, maybe not now, maybe not ever. So let's get started with a little bit of work around the meaning of words. As Frank mentioned, my undergraduate degree is in philosophy, so I got to indulge myself with 4 years of thinking about the precise meaning of what are, in many contexts, relatively vague terms. And I've applied that training to my business studies. So strategy is a word that in colloquial use has many different connotations, and that's fine. It carries different buckets of water in different contexts. I find it helpful when trying to think carefully about strategy to think of it in these terms. And I've suggested them in the title here, that strategy is about being different from your competitors by embracing constraints. And let me try and illustrate what I mean by that by way of reference to the hotel business. So in the hotel business, there are any number of dimensions of performance that matter. And you can see here on the horizontal axis, I've shown performance from low to high. But performance has a number of different components, right? Functionality, convenience, and then price is its own dimension, right? That is the vertical axis here. And take note, it goes from high to low. So it's an inverted scale in order to capture the fact that as price goes down, consumer value goes up. So as we move from left to right on the horizontal, performance is increasing. As we go on the vertical axis from high to low, price is decreasing. But in both instances, as you move farther from the origin, consumer value is greater. So I wanted to unpack that with some care because we'll be making reference to this, this two-dimensional space repeatedly. So in the United States, some of you may be familiar with Motel 6. Motel 6 is a highway-based motel chain. They have a very homey slogan. It says, "We'll leave the light on for you," which is intended to be welcoming. But frankly, what it really means is that the only thing they'll guarantee you is that when you show up, it won't be pitch black. After that one light bulb hanging over the door, you're on your own. It is a very low-priced hotel. They're quite profitable because they have very low costs. And they have very low costs because they do not invest to any great degree in many of the amenities that you might think define more luxurious accommodations. And everybody's fine with that, right? Everyone understands the value proposition that Motel 6 brings to the marketplace. And as a consequence, there is a limit to what they can provide. And that's captured here by this green curve, which I refer to as the production possibility frontier. I've imported that term from microeconomics. And what it's intended to represent is the limit of the performance that Motel 6's business model can deliver at different price points. And you'll see here that they are able to go very high up the price axis, right? And what that means is that they're able to deliver very low prices and still be economically viable. But the level of performance that they deliver on that dimension is actually quite low as a consequence. And that makes sense, because when you're a hotel, an accommodations provider, there are costs that simply cannot be avoided, right? You have to build a hotel, and the more luxurious, the more expensive. The location matters too. If you put it on the exit ramp to a highway, it's going to cost a lot less than if you put it in the center of a metropolitan area. The consequences of those choices is that Motel 6 has a very hard ceiling on the level of performance they can provide. If you show up at Motel 6 and say, look, money's no object, give me the best room in the place, you'll be lucky if you get something that's not next to the dumpster and the garbage cans, right? So there's limits to what they can deliver. But once again, nobody's confused, right? This is not a criticism in the slightest. It's simply a description of the constraints on delivering accommodation services that Motel 6 has embraced. They know precisely who they are. They know precisely what segment, what bracket of the market they seek to serve, and they make the choices consistent with that desire. A second hotel chain, Crown Plaza, a business person's hotel, generally located in okay parts of larger cities. They have a very different production possibility frontier, right? They have more luxurious accommodations. They don't have 24-hour room service necessarily, but they have nicer rooms, bigger rooms, nicer sheets, better appointed lobbies. There'll be a restaurant in the hotel. And as a result, they are able to deliver higher levels of performance, but with what comes with that, of course, is higher costs and as a consequence, higher prices to consumers in order to pay for all of that. And what you see is that where production possibility frontiers overlap, the frontier that lies above all the others is the one that's going to win for that particular segment of the market. So for those customers who really require lower prices and are willing to accept lower performance to get it, well, they stay at Motel 6. And for people who have more money to spend and enjoy and value the higher performance that enables, well, they stay at Crown Plaza. And then the very lucky few, well, they go stay at the Four Seasons, right? The Four Seasons, again, has a very differently shaped production possibility frontier, much higher levels of performance, higher costs to go with it, higher prices as a consequence. And once again, these frontiers show the limits of what different business models can deliver. If you show up at Four Seasons and say, you know what, I'm on a bit of a budget, well, then the price will drop all the way to $650 a night. Right? So these very different frontiers are ways of representing the different combinations of constraints that each of these businesses have embraced, not in order to be better than their competition. Is Four Seasons a better hotel than Motel 6? Meh, I don't really think so. It's almost an incoherent question because they don't compete with each other, right? So it's not better or worse. It's fundamentally a question of difference. So when I think about strategy, I think about the constraints that define the choices and the collection of choices that companies make to define how they choose to be different from their competition. Now, I promise I'll pick up the pace from here, but I wanted to introduce those constructs because we'll be referring to them repeatedly as we unpack the next two ideas. So if you think about innovation in the context of how we've defined strategy, if strategy is being different by embracing constraints, I'm going to suggest that innovation is about being better by breaking constraints. Because after all, the story of human progress is the story of breaking constraints, not simply slicing markets in ever finer slices. So the trade-offs that define strategy can sometimes be broken. And when that happens, that's what I'm prepared to call an innovation. So think about Airbnb. Airbnb shows up, and where hotels are constrained by the cost implications of having to build hotels in specific locations, and as a result of that fixed cost, they have a huge price overhang that they need to recover. Airbnb mobilizes otherwise dead assets, and as a consequence is able to provide levels of accommodation that compete across the entire scope of the market at dramatically lower prices. Historically, if you wanted 500 square feet of accommodations in Midtown Manhattan, you had to go to the Four Seasons and you're going to pay $1,000 a night to get it. But now all of a sudden, somebody with a penthouse suite at 54th and 7th, who's going to be away for 3 or 4 days, will rent out that same space for $300 a night. Now, it may not have all of the accompanying services. So at the limit, there are still trade-offs that matter. But Airbnb has fundamentally broken a defining constraint of the hotel business. And in breaking that constraint, Airbnb, to my way of thinking at least, constitutes an innovation. And its production possibility frontier subsumes pretty much every other player in the market. And its growth and profitability are testament to that. So where strategy is about being different by embracing constraints, innovation is about being better by breaking constraints. Finally, our third construct is uncertainty. And in this context, I'm suggesting that uncertainty amounts to simply not knowing what the constraints will be. You may know at a point in time what they are, but it's very difficult to predict how they will change over time. And indeed, in the panel conversation we had just a few moments ago, folks were talking about how changes in government and policy and so forth are quite common. And certainly I think that's true worldwide. And I would observe that those policy changes amount to changing the rules of the game. They change the constraints that define the competitive space, and that's a real problem. Sticking with the hotel business, the changes that hotel providers, accommodations providers are wrestling with are things like the rules of the market. So Airbnb, for example, got its start by exploiting various gray areas and loopholes, many of which have since been closed. And that has really impinged on their ability to offer services in certain very valuable jurisdictions, not least New York City. The size of the market is also an issue. This is unfortunately an image that many of us have become all too familiar with from the news reports around the novel coronavirus. And that, of course, has led to all manner of shutdowns and restrictions on travel and so forth that have, to say, dramatically reduced the size of the hotel market is an understatement, to say the least. And furthermore, not just the size of the market, but even the addressable market becomes a problem. Some of you may be aware of the political landscape in the United States is becoming enormously fractious. And Airbnb reports that one of the dimensions they now have to provide is what are the political leanings of both guests and accommodation providers, because Democrats won't stay with Republicans and vice versa. And so as a consequence, all of a sudden, when the rules of the market change, the size of the market changes, and the addressable market changes, what looked like a fantastically successful innovation just 18 months ago suddenly feels like its future is in question. Not because there's anything wrong with the strategy, not because the innovations aren't valid, but because the rules of the road, uncertainty, if you will, has undermined what seemed like valid assumptions. So strategy, innovation, and uncertainty. So now what I'd like to do, and Frank, I'll defer to how you want to run the session. I'm more than happy to entertain comments and questions as we go along. As I like to say, I've seen all these slides before, so this presentation can be much more interesting sometimes if people want to get involved as we go along. In any case, what I'd like to offer now is what I think I've learned about success with respect to each of these three concepts, right? Strategy, innovation, and uncertainty. And the three rules, which came out in 2013 with Mumtaz Ahmed, then the chief strategy officer of Deloitte and a longtime friend and colleague, was our attempt to understand what made for good strategy. And so we defined exceptional financial performance in terms of profitability over time. And we concluded that the way to maximize the probability of achieving exceptional performance over time is to follow these three rules, not just even when, but especially when you don't want to. And let me say more about what I mean by that. I'm going to begin with my punchline, right? So in my view, the defining trade-offs of competitive markets are boiled down to three fundamental questions. First, how do you create value for customers? And that leads us to rule 1, which is better before cheaper. So when you have to choose between creating value for customers by delivering a better solution and greater value versus similar value at lower price, the driver of superior profitability over time is competing on the basis of quality and performance rather than competing on price. Of course, it's no good simply to create value for customers if you don't keep any of it for yourself. So capturing value is a function of actual profitability. And there we conclude that, again, the odds-on favorite is to drive profitability through higher revenue, either through higher prices or greater volume, rather than trying to maintain a cost advantage over your competitors. Now, each of these 2 rules, I think, are valid rules because the contrary could well have been true. It's not an incoherent statement to say it makes more sense to compete on price or the key to profitability is a low-cost position. In fact, there are plenty of people who believe that is in fact the case. And frankly, there are examples of companies that have delivered tremendous performance over time with precisely that approach. But our data and our analysis reveals that by far the better bet on a probability basis is to focus on better and revenue rather than cheaper and cost. And finally, how do you cope when the world around you changes? Well, that led us to rule number 3, which somewhat tongue-in-cheek, but nevertheless entirely seriously at the same time, is that there just are no other rules. And what that means to us is that for all of the other things that we know absolutely matter to the success of a company, whether it's its ability to innovate, whether it's human resources policy, whether it's government relations capability, you name it, all of the other things that we know matter, supply chain management, it's a very long list. Our view is that all of those things matter only instrumentally. They matter to the extent that they allow an organization to hew to rules 1 and 2. And so in that sense, those other things are important only when they are driving an organization's ability to follow rules 1 and 2. I'll give you an example for each of those 3. But first, I want to explain where those conclusions come from. We looked at 45 years of data on 25,000 companies, all publicly traded organizations in the US between the years of 1966 and 2010. And we divided their performance into 3 categories. We looked at companies that landed in the 9th decile of return on assets, so the 90th percentile, the 9th decile of return on assets, sufficiently frequently over time that we could be highly confident that it was more than just luck. You know, as they say, even a broken clock is right twice a day. So we're not looking for companies that deliver some bottle rocket performance. We're looking for sustained performance over time, and sustained wasn't defined by us. It was defined by the statistical improbability of specifically observed profiles. And so 174 companies cleared those statistical hurdles, and we called them the miracle workers. We then looked at companies that landed in a band of strong but not head-snapping performance, right? The 6th to 8th decile, again, over this 45-year period. And 170 companies were able to deliver performance in that band sufficiently frequently, conditional on their survival, to be confident that they'd done something special. And then finally, we identified a population of companies we called average Joes, companies that had levels of performance, and this is critical, levels of volatility in performance that were essentially average for the population. And the reason that volatility is important is that if a company landed at the 5th decile, median performance, each and every year, every single year for 15 years in a row, that would be its own type of freakish performance profile, right? So it would be like the average family had 2.2 children, and you found a family that had 2.2 children. Like, that just doesn't happen. So we weren't looking for average performance, but average performance and average volatility over an average period of time. And along those 3 parameters, we got companies that looked, well, average. And so we called them average Joes. We then compared the performance of companies within similar industries competing over similar periods of time in order to determine what the key and defining differences were. And that's what led us to our 3 rules. The first of these then, better before cheaper, right? How do you create value for customers? Well, in the world of strategy, which remember is about embracing trade-offs, we're not looking at those organizations that manage to deliver lower price and higher quality simultaneously. That does happen, but it's pretty rare. In reality, what's far more often the case is that companies face a choice and they have to decide where on that industry's frontier they are going to position themselves. And in general, what we found is that by and large, companies that had low price, low performance positions were tended to be average Joe organizations, right? The green is the average Joe. The red, those are the long runners. And so what we saw is that companies that had middle of the road positions, right, at middle of the road price, middle of the road performance, those were dominated by the long runners. And you guessed it, the companies that have high performance, high price positions within their industries, well, that is dominated by the miracle workers. Now I'll go back to something I said earlier. Our findings are essentially probabilistic in nature, not deterministic, right? If the average, if that bubble down at the low end there, low performance, low price, if that was solid green and then solid red and then solid blue, well, I could have called the book The Three Laws. But these are not laws of physics, they are rules. They tend to apply in the aggregate over time when followed consistently. They're not guarantees of outcomes, I'm afraid. Nevertheless, I think they are very powerful and very useful guides. So I'll give you an example of how this plays out. There's a company in the US, a discount retailer called Family Dollar. And I'm using Family Dollar as an example here for a very important reason. It's not uncommon when I talk about this particular rule for people to say, oh, so everybody should be the Four Seasons and Rolls-Royce and Emirates Airways. Well, no, not at all. The issue here is to understand your position with respect to the relevant competition. Right? So Family Dollar does not compete with Neiman Marcus, a very high-end retailer in the United States. Family Dollar competes with other relative discount retailers, right? So Dollar General, Walmart, a whole variety of other discount retailers. And it turns out that within that category of relevant competition, within that discount retailer space, Family Dollar, in fact, enjoys a very particular performance price position that you can characterize as high performance and higher price. And indeed, Family Dollar does have higher prices. At least it had higher prices during its 27-year run of superior performance. It had among the highest prices in the discount retail space, but it delivered a level of convenience, which was the relevant dimension of performance for an important subsegment within the discount retail customer space, that allowed them to deliver exceptional profitability for almost 3 decades. A truly unbelievable run, and one that, frankly, very far below the radar. Because when people talked about superior performance in discount retail in the United States in the 1980s, 1990s, and early 2000s, they invariably pointed at Walmart. But what was overlooked is that it was Family Dollar that was delivering the truly exceptional performance, almost 2 percentage points of ROA greater on average every year for nearly 30 years. And they did it by focusing on better before cheaper within the discount retail space. Rule number 2, revenue before cost. I apologize for doing some management accounting here, but I promise it won't hurt. Right? Return on assets is simply income over assets. Income is revenue minus cost. Revenue is price times volume. And what that creates is what I call the triathlon of profitability, right? There are 3 events. There's price times volume, there's cost, and there's assets. And each of those levers can drive superior ROA, provided you can pull it in the right direction at the right time. And when we look at the structure of the performance advantage of our 3 pairwise comparisons, we see dramatic, indeed very statistically significant differences. When you look at the performance advantage that miracle workers enjoy over average Joes, that is the leftmost column, what you see is that miracle workers enjoy an advantage in all 3 events, if you will. And that's really not a surprise. If you think about the Olympic triathlon and you compare the gold medal winner to somebody who finished in the middle of the pack, they probably did better in the swim, the bike, and the run, right? They're better at all 3. That's not a surprise. When you look at long runners versus average Joes, you see a similar advantage in all 3 dimensions. But as you can see in that middle column compared with the leftmost column, there is a very different structure to that advantage, where miracle workers are relying on price and volume for fully 60% of their advantage. Long runners are relying on a cost advantage for 60% of their advantage, right? Pulling a very different lever, one that statistically is limited in its ability to drive superior performance. And this is the one that really snapped our heads back. When you look at miracle workers versus long runners, what you see is that on average, miracle workers rely on a price or volume advantage for fully 80% of their superior ROA when compared to the long runners. And that thin red bar in the middle, the cost advantage, remember that's just on average. Fully 40% of miracle workers have an inferior cost position. That is to say, they are higher cost than the long runners over whom they enjoy a significant profitability advantage. So I'll give you an example of how that can play out. Linear Technology is a microprocessor manufacturer based on the west coast of the United States. Based on the west coast, let me go back here. Based on the west coast of the United States. And for a long time, they were stuck in a race to cost leadership in microprocessor technology. And that was simply not a race that they were going to win. They lost out to the likes of AMD and Intel, as you might expect. As a result, what they started to do was focus very carefully on segments of the market that where their chips were actually a very low percentage of the total cost of a specific device, but a driver of competitive advantage. So to give a specific example, if you've ever rented a car, you may have returned the car and then someone comes out to check your car back in. And when they do that, they're using a handheld device, a wireless handheld device to check you back in. Those are very particular chips, and Linear Technology was a pioneer in designing and manufacturing those microprocessors for that specific application. And in those devices, the linear chip was something less than 5% of the total bill of materials. It was almost 100% of the differentiation of the devices, because what the chip enabled, wireless connectivity, the wireless communication, and the speed and reliability of that, which is clearly everything with those kinds of handheld objects. As a result, Linear was absolutely essential to the manufacturers of the handhelds. But as a small percentage of total cost, Linear was in a position to charge pretty much whatever it wanted. What Linear had to embrace was the ability to manage literally thousands of customer accounts, ordering relatively small number of chips. But as a consequence, it was able to enjoy both and volume advantages, again, within the context of the relevant competition, that allowed it to be spectacularly successful over many decades. Finally, rule number 3, there are no other rules, right? It wouldn't be a strategy presentation unless we talked about one of the big famous companies out there. Apple has had a long, indeed, and storied history of innovation. Not all of them successful, by the way. Some of you may remember the Newton, some of you maybe not. Some of you may remember the Lisa. Actually, I'm willing to bet very few of you remember the Lisa. But then there have been the big hits, right? There have been the iPad, the Mac, the iPhone, the iPod, to that. Apple has successfully pursued many different types of innovation: disruptive versus sustaining, breakthrough versus incremental, product versus business model, you name it. These folks have done it, sometimes well, sometimes poorly. But I will submit, always with an eye to better before cheaper and revenue before cost. And when they drive revenue, it's not always with huge price premiums either. In fact, for a while there, the iPad enjoyed both a price and a volume lead because of the enormous performance advantage it enjoyed over the competition. So yes, Apple is an innovation-driven company in many ways, in my view, but its innovation has proved successful to the extent that it has delivered adherence to rules number 1 and 2. So that's what I think I've learned about strategy: better before cheaper, revenue before cost, and after that, there are other rules. But what about innovation? If you're faced with a need to embrace a constraint, those are the constraints you embrace. What do you do about innovation? Well, I think successful innovation is breaking the right constraints in the right way. And here's how I think one goes about that. Disruptive innovation is about starting at the low end of a market and moving up. So think about the home video business in the United States in the late 1990s. You had Netflix with mail order DVDs, Blockbuster with renting DVDs in stores and then video on demand from the cable companies. Netflix at the low end, renting them in the middle, and VOD at the high end. What Netflix was able to do was march its market, its model up market. It broke the constraints by moving to streaming video over the internet in ways that allowed it to expand its production possibility frontier, overtaking Blockbuster and video on demand. It started out by accepting a trade-off, giving very low levels of service because your DVDs show up in the mail, but very low prices, to a solution that allowed you to stream whatever you wanted, whenever you wanted, on whatever device you wanted. And oh yeah, it was still really cheap compared to the alternatives, right? So it started out by embracing constraints at the low end and then broke them over time to compete for the entire market. You can break trade-offs all at once in the middle of a market. If you think about hired rides, you've got public transit, you've got cabs, and you've got high-end limo services. Well, of course, Uber shows up and they simply broke all the trade-offs all at once. They provide, again, releasing otherwise underutilized labor and assets in the form of drivers and cars. Uber was able to deliver greater convenience at lower cost and price than the established solutions. And as a consequence, it's been able to grow very rapidly globally for several decades now. And finally, you can come down from the high end. Let's call that devolution, the evolution of electric cars. At the low end, you've got the Nissan Leaf, you've got the Chevy Bolt in the middle, and the Tesla Model S and now the Model 3 at the high end, right? When the Tesla Roadster and the Model S in North America, these were $130,000, $140,000 automobiles. But what Tesla is betting on is that over time, it will be able to break the trade-offs, maintaining its extraordinary level of performance, right, where the Nissan Leaf range of 150 kilometers, Tesla Model 3 has a range of 530 kilometers, so delivering ever-increasing distance, ever faster charging, and ever lower prices, right, by breaking the trade-offs that define its underlying technology. So we've got Netflix coming up from the bottom, we've got Uber breaking those constraints from the mid-market out, and Tesla starting at the high end and then breaking constraints to move down. And I would be a strategist if I didn't have a 2x2, so this is how I think about that. As you're exploring opportunities to innovate, think about the solution that you can provide right now and map it to the requirements, both performance and price, of the mainstream market you hope ultimately to compete with. You'll find the prices are either too high or good enough, and you'll find that your performance is either too low or good enough. And depending on where you are starting, that will define the constraints you must break, the innovation, if you will, that you need to pursue in order to be successful. It is in fact a complete 2x2. If you think about the evolution of cellular telephony, it started out both with prices that were far too high and performance that was far too low to compete with landlines in North America. But over time, prices dropped and performance increased until finally cellular has essentially disrupted landlines. So you can start from one of those four positions, and provided you are able to identify a segment, that is to say, provided your solution has a successful strategy, embracing certain constraints to be different and deliver unique value to a specific segment, that sets you up for innovation, to break those very constraints and compete for larger and more profitable markets over time. Finally, uncertainty. This was the strategy paradox. And the idea is that to enable change, we have to reduce risk, but somehow find a way to preserve our ability to commit. And here I'm going to point to uncertainties in the technology and services space. So if you think about the large players in the North American online market, there are any number of product and service compete in, whether it's cloud computing, whether it's advertising, online shopping, devices of various types, or indeed delivering media content. All of these different areas seem to be convergent and complementary in important ways. But it's not enough to just wait until that uncertainty is resolved, right? If you think about the competition between BlackBerry and the iPhone back in the mid-2000s, it wasn't immediately clear that the iPhone was going to be hugely successful. BlackBerry, the dominant player at the time, which to my chagrin was just up the road from me in Waterloo, Ontario, looked at the iPhone and said, "No, I don't think that's going to. We're going to stick to our game, and if they figure out anything important, well, then we'll adjust accordingly." But we know all how that unfolded. Similarly, Blockbuster looked at Netflix and thought that's never going to fly. In fact, the story is that Blockbuster had the opportunity to buy Netflix for $50 million and passed on it. That was the foregone. That's the one that got away, to say the least. So you can't sit back and wait until the uncertainty is resolved, in large part because by the time the uncertainty you care about is resolved, it's probably too late to do anything. And second, the uncertainty is never resolved because there's always something new on the horizon that's important that you can't predict. Forgive me, I'm just seeing the chat now. Oh, there we are. I will indeed be wrapping up. There we go. Agility is important, but there are limits. It's one thing to be an aircraft carrier and decide you want to be more agile, but small boats move faster, but they don't carry airplanes. So agility imposes trade-offs that are somewhat crippling. And so what I think the major players have done is they have identified where they are going to commit, but then they identify areas where they need to create options, those question marks, and then places where they simply don't play at all. Right. And so by building a portfolio of positions, they allow themselves the latitude to move quickly because the assets and capabilities are being developed without spreading themselves too thin by leaping on their horses and galloping off in all directions. And so, and this is the last slide, if you think about strategy, I've suggested that that's about embracing trade-offs. And that consists of those three rules. Innovation is about breaking trade-offs. And so I've said something about what trade-offs to break and how. And then finally, when it comes to uncertainty, it's about trying to avoid trade-offs by understanding where you're committed, the risks that you face, the consequence, the options you need to create. And so that gets us back to where we started. Strategy, innovation, uncertainty, to my way of looking at least, an eternal golden braid. So with that, I conclude. I hope I haven't overstayed my welcome by too much. I will get rid of those slides and hand it back over to you, Frank.
Thank you very much, Micah. What a presentation. Thank you so much. Thank you. I'm glad you're going to stay with us to join in a chat that will follow. Now, I'm going to have a fireside chat in which Michael will be participating, but I will also have Wally Oshie, Group Managing Director of Custodian Investment, as well as Sonia Ayere, Chief Executive Officer of Don Lauren, and of course, Carl Toriola, Chief Executive Officer of MTN Nigeria. Before we go into that conversation, there's a lot packed into the presentation by Dr. Raynor, which we will be, of course, talking about. I think we have a message, so let me yield to my colleague, Rolly, and thereafter we will go to the fireside chat.
Thank you.
It's 6 o'clock in the morning, getting set for another day. Another chance to change my story. I believe in my hustle. I know be lazy person, but life is just a knock me gospel. If it don't close, I go find another. If I fall down, I go try to cover. If you never walk me, I know they another, cause I believe say I go surely prosper. You don't get that say one be, we move. No matter what they do, we move. Ooh, yeah. Say we move. No matter what they do, we move. I don't go let wahala hold me down. Oh yeah, oh yeah, oh yeah. I don't go let wahala hold me down. Oh yeah. I don't go let wahala hold me down. I don't go let wahala hold me down. No matter what they say, we move. We move. Oh yeah, oh yeah, oh yeah, oh yeah. No matter what they do, we move. Oh yeah, oh yeah, oh yeah, oh yeah. I don't go let wahala hold.
Thank you, everyone. I would like to hand over now to the publisher, Frank Igogo, for the Fireside chat. Over to you, sir.
Thank you very much. Thank you. Let me again welcome my panelist, Dr. Michael Raynor, Mr. Wale Oshin, Group Managing Director of Custodian Investment Group, Mr. Sonny Ayere, Chief Executive Officer of Don Lauren Merrifield, and of course, Carl Toriola, Chief Executive Officer of MTN Nigeria Limited. Let me just get Michael to open up the conversation a bit by asking him. Now, what would you is the common thread running through all these three books, the Three Rules, the Innovators Manifesto, and of course, the Strategy Paradox? What are the key threads running through all the three of them?
I think the unifying construct is really just the notion of having to make choice. That's unique. Focusing on that is hardly unique to me. I think people, there's I'll dare say a general consensus in the study of strategy that strategy is about an integrated set of choices directed to achieving a particular outcome. Right? That's kind of that's a bumper sticker definition, not particularly eloquent in my view, but a bumper sticker definition that has taken root in a number of circles, and I think it's accurate and helpful. What I've tried to do is pick up on that notion of choices and constraints and understand the circumstance. It's important to accept those constraints, and when faced with those constraints, which choices to make. The circumstances in which it may be possible to break those constraints, pursue innovation rather than strategy. And then finally, cope with the fact that you don't always know how constraints will change over time. That's the uncertainty piece of the puzzle. So it's that, I guess, is really what I would, what I have come to realize is the unifying thread. And again, as I said at the very outset, that's not something that I would have figured on when I started all of this 20 years ago.
Thank you, sir. Let me turn to Sonny for my next question. As Dr. Raynor has said, we live in the age of uncertainty. And of course, uncertainty implies uncertainty. I don't think there's any other way that I can explain it. But as we know, there is a potentially huge payoff for those who make the correct bets. And of course, on the reverse side, huge losses if the bets go wrong. Sonny, a few months ago, your company, the investment bank that you funded, bought a microfinance bank and has been eyeing the fintech space. Neither of the two areas where investment banks traditionally play. How should we read this move about your guess on the future?
Thank you very much, and let me give the opportunity to all, to everybody featured here, Carl, Wale, Michael, everybody else, especially Frank. Thank you for this. Yeah, I mean, look, we took a decision that the future of financing is not just the typical investment banking business, but more looking at where the world is going in terms of green. We're looking at things like the ESG models, and looking at how we can actually play more in the space of where you can add value to people, planet, and obviously, of course, profit. So the idea of moving more into the fintech space sort of made a lot more sense in following that sort of ambition, and also following and looking at where the world is going, where the trends are actually moving to. Also, we looked at the Africa Free Trade Agreement and looked at what sort of platform would be best to actually take advantage of that opening of the African space. And I think the digital banking model seemed absolutely perfect for that. For me, it was good because my true background is credit, and we started with obviously looking at normal micro loans to individuals, consumer loans, etc. And so far, we've done pretty good. And the idea is to actually be able to scale that first within Nigeria, and then scale that actually into some of the other countries across the continent. The idea, of course, being then to sort of diversify, one, regulatory risk, political risk and currency risk, and so on and so forth. And then also taking advantage of that teeming and growing population that we have, and then using technology, which seems to be the most important thing across parts of different industries to drive our business strategy.
Thanks, Sonny. Carl, let me come to you. As part of his bet big, lose all thesis, Dr. Raynor has a very interesting view on the subject of strategy. Rather than a single static corporate strategy, he tends to suggest that companies should have an arsenal of strategies built on different scenarios that can be activated as market conditions play out. For as he said, uncertainty it means uncertainty, So let me ask you, do you think CEOs and divisional heads at most companies can manage this type of complex strategy gaming or strategy flexibility thinking from your experience?
So good afternoon, everyone, and an amazing talk by Michael. Thank you. A lot of insights. I really would like that presentation. I'd like to go through it with the team. Look, it's challenging, and it's challenging because there are so many routes to value creation in your strategy, and pursuing all of them and choosing the right one to allocate your resources to today is difficult. I've consistently said my personal view, strategy is a word which is used many ways, but it comes down to an allocation of resources. And also, to use a very cliche expression, I think what will drive the selection of where you put those resources, i.e. your strategy, is having the right organization culture, which has the capability to adapt very quickly. There are a few challenges which face, first of all, being able to spread your options around many strategic initiatives at the same time, and then being able to choose the right one to invest in, which is, i.e., as I said, an allocation of resources, both human and capital resources, into the path of revenue growth or cost optimization or customer service progression, which you want. And the limitations to this factor, and I mean, culture is always going to dominate this. But one thing I found over time is the ability for the organization to confront the home truth. And perhaps that's something for Michael and for Wale and everyone else on this. Think that does your organization confront the home truths that are staring you in the face? Because we all lead organizations, and particularly for MTN, which is so huge. I mean, the growth of MTN in a single year is automatically going to give you a sense of complacency. When you're leading such an organization, I think Custodian is like the largest insurance company in Nigeria. Complacency becomes deep-rooted, and you can be walking towards a freight train going at 200 miles an hour, and your entire organization, including the CEO, and in very few instances, the board will not see this. So if you have a culture in your organization of one, continuously confronting the most uncomfortable truth industry, your business, your economy, your whole ecosystem is facing, then you have a chance of coming to the right answer. And not a subset of that, because a culture of the organization actually makes you confront or deny the home truths. But if you have the culture of agility, then you can actually change your strategic initiatives and your allocation of resources to focus on one of the multiple options, which are very difficult to juggle, but that will create value for you. I hope I've answered it to some extent or the other.
Precisely. Let me just ask very quickly as a follow-up, given that you spoke about this. I mean, why do you think some companies choose to deny or ignore the home truth?
Well, one part comes from a legacy of being continuously successful and seeing probably incremental performance by default, not as a result of necessarily the performance, the strategy, or the leadership of the organization. The second part is confronting the home truth, and I've experienced this, is very, very uncomfortable for management.
Okay.
Effectively, what it tells you is you're not prepared for the future. You haven't read what's coming, and you need to change very radically. And some of it is cost structures. You need to change your own compensation model, et cetera, et cetera. And change comes difficult to everyone. So if those are the two big reasons that I would give, I think it's because change is difficult, and confronting the home truths often means you have to acknowledge that you have missed some things, or you've been as agile, as adaptable as you think. And because if you're very successful, it's very easy for a company that's about to go bankrupt or into negative cash flow to change. Try to do that to a large organization, Custodian or MTN. It's a lot more difficult. So once you're successful, it's quite difficult to get that change to happen.
Thank you very much. Let me turn to Wale. In his 3 rules, how extraordinary companies think, Michael Raynor and his co-author distill strategic choices made by the most successful companies down to 2 or 3 rules. Firstly, pursue better before cheaper, meaning it's better to compete on differentiators other than price. Secondly, revenue before cost, that is prioritizing increasing revenue over reducing cost. And then, of course, there are no other rules, so change everything else you are doing and follow the first 2. So, Wale, I mean, Carl has alluded to the size of your company, large, diversified company. Have you found these rules working in your own circumstance at Custodian?
Well, thank you very much. And thank you, everybody. I think, when Mike was presenting and I was thinking about this, it's actually a natural thing to think about, that you're going to present, a better offering to your customers, and you want to do it at a cheap price. But sometimes, you need to also look at the environment. I mean, what kind of environment do we find ourselves? What's the disposable income? Can you actually pursue quality, at a high price in an environment like this? What's the earnings power of the people that you're marketing, that you're selling your products to? So really, as much as that is the ideal situation and what all of us will want to be like the miracle workers, as he has alluded to, I think it's we just have to find a balance, somewhere. One of our lines, which is of course insurance, and some of the products in insurance, the way the market is, it's commoditized. There's no differentiator. It's just price. And if you think you're going to compete based on that differentiator, you probably have to stay in that market for about 2 years, trying to let the entire universe of customers understand your value proposition. And by that time, God save you. So really and truly, I think, one has to find that middle point, where you can give the offerings and also be sufficiently price sensitive for people to gravitate towards your product. In terms of revenue, I've always been a revenues guy. Cost is important. I look at cost, but I always believe that if you drive revenue, you'll be able to contain cost. If you look only on the side of cost, then ultimately you may lose sight of market share. So I'm a fan of revenue driving, and we do everything to do that. So it's a unique environment that we find ourselves. I think sometimes it works better in a stable, much more stable economy, where the earnings power of the people, is a lot higher, and they are discerning. They actually can weigh pros and weigh situations before making a buying decision. But in Nigeria, and I dare say in Africa, the first thing people look at is price. Interesting.
At Custodian, you've done a number of very transformative mergers and acquisition deals. And last year, you took a majority stake in UPDC, a property, top line property development company. So what is the gap that UPDC helps to plug, and what is a new world of uncertainty that it may have opened for you?
Well, I think that transaction for us is complementary. It's complementary to our offerings. Apart from the fact that we'll also be solving a 20 million housing deficit or gap that we have in Nigeria. Of course, the space is right there, and it's open. It complements our lines of business. We're in the pension business. We're dealing with long-term funds and so on and so forth. We have life insurance. In the property arm, we have the real estate investment and trust company, which will ultimately deal with the issues of housing deficits, in the country. Tied to the entire universe of all this are the opportunities for us to also insure, all these houses all across, some of them which are under management from our facilities management company, which is also under UPDC. So it's the value proposition that we see, there is not only, to take advantage of that gap, that housing gap, but also, having to plug in another product line, which is diversified and completely, well, not completely, away from where we are, which is, a completely regulated environment, but also being in a space that the long-term portfolio of funds, can support the growth and development of that entity. So that's the view to it.
Thank you very much for the much you have told us without looking at so much in terms of where you're going in the future. Let's return to Dr. Raynor. Your views are quite known about the category of books that focus, management books, that is, that focus on success studies. And they include such books as In Search of Excellence, Built to Last, Peak Performance, Profit from the Core, Creative Destruction, Good to Great, What Really Works, Blueprint to a Billion, Big Winners and Big Losers, The Breakthrough Company, Small Profits, then The Momentum Effect. I may not have been very successful in fully classifying these books, but let me ask you, what do you think accounts for the enduring success of these books and the area of literature that management literature that they pursue, despite the evidence you present to the challenge in their veracity?
That's a kind of a loaded question, I think. Let me try and unpack that. I'll back up just half a step because some of the folks on the session may not understand the context of the question. So when we did the 3 rules, it is in one regard, a classic success study, right? We went out and scooped up a bunch of companies that had delivered a particular performance profile over a period of time. And then we wanted to study those companies to see what drove their success. That's a common approach in business books. And I think it's an understandable reason, which is that when you're dealing with such an enormously complex phenomenon, right? When you can't do double-blind controlled laboratory studies to determine what creates successful companies, you have to study them in the wild, right? This is not biology where we can culture E. coli in a petri dish and control all the other variables and figure out precisely how phosphate concentrations affect cellular growth. This is not that kind of a problem, as everyone I think intuitively, if not explicitly, understands. And so to try and understand what creates a successful company, we have to look at all the moving parts all at once, all the time. Right? We can't create the kinds of controlled experiments that isolate all the relevant drivers of success. We do the best we can, right? We look at companies that compete in similar segments in the same industry over similar periods of time. That's one way to get rid of a lot of the difficulty, right? So you don't look at a steel company in the 70s and compare it with a software company in the 90s and say, gee, what's the same about these? That gets pretty tricky. Right. So, but despite those best efforts, it's very difficult. So you're forced to study high performing companies in order to understand what drives high performance. And that's why success studies, I think, remain a durable research method. And what Mumtaz and I tried to do with the 3 rules was participate in that particular method. And then we tried to bring what we hoped was a new dimension of value, which was what we believe to have been a more statistical toolkit in order to tease out companies that had been just lucky from those companies that in fact had delivered high performance. And that really is, to my mind at least, since you asked, to my mind, the key differentiator of the 3 rules, where the books that you mentioned, and we don't pull any punches, we name names, as they say. We look at the companies that those other studies have held up as exemplars of high performance. And what we concluded is that you actually can't say with sufficient certainty that those high performers were actually high performers, right? And so I use the example of the coin flipping contest. There's 13 people on this Zoom call right now. If we had a coin flipping contest, the winner would probably get 5 in a row. And if we went to that person and said, how did you flip 5 coins and 5 heads in a row? They would come up with an explanation about, it's their genius or their, intuitive understanding of the physics of coin tossing. And that's basically what happens in a lot of these success studies. They look at when you have such a noisy system as the competitive markets, the competitive public markets in North America, you will get streaks of good performance simply as a result of the variation of the system rather than a result of the choices of the individual player. Precisely. And the only one, sorry, go ahead.
No, I said precisely. No, finish.
Yeah. So that's what we tried to do, right? We tried to, and we quantify our level of certainty, right? You're never 100% sure. Mm-hmm. So we quantify the level of confidence and we say, right, we think these companies to a specified degree of confidence have delivered performance that's more than just lucky. So we think it's worth studying them. Because after all, if you're going to understand success by studying success, you have to be able to identify success. Precisely. And that's not as straightforward as you might think.
Thank you very much. Thank you. Thank you. Sonny, let me come back to you. Dr. Raynor, of course, says that the main task of a CEO is managing uncertainty. And of course, one of the ways that businesses have tried or have adopted to manage uncertainty involves things like scenario planning where they then seek to imagine the various options of what the future might hold. If that is so critical, so central, and such a core part of the work of a CEO, how is it then that many companies, whether big or small, do not seem to see disruption heading their way until it lands at their doorstep?
I will answer this. It's like looking at you know, the other participants on the panel. So MTN, Carl, and Wale, the custodian. These are, you know, it's very big and it's within the African content. And it is already a major day-to-day grind, just keeping these companies moving the way they do. And therefore, you know, to begin to anticipate what could change or what could not change becomes a lot more difficult. So if you listen to what Michael was saying earlier, giving the examples of, I mean, for those who remember, I'm sure a lot of us do remember, Blockbuster vis-a-vis how Netflix, and you look at someone like Kodak and what happened with phones, or, you know, there's so many major disruptors that's happened. Being able to anticipate that, it's, to my mind anyway, it's very, very, very difficult, because even in the industry you are, what you're doing on a day-to-day basis is actually already a task and a half trying to keep these companies running. And therefore, I really don't blame people like Nokia for losing that position they had to BlackBerry. BlackBerry losing the same position that they had to Apple, and so on and so forth. A lot of people they just couldn't see it. So if I look at what happened to, say, let's say the transition between Nokia and BlackBerry, for instance, it was all to do with email. It was all to do with email. In fact, there was a time when most people carried both a Nokia and a BlackBerry. BlackBerry was principally for emails, and Nokia because most people were used to carrying a Nokia. But over time, people dropped the Nokia and stuck to BlackBerry. Look at another example, WhatsApp. And what was it again? I think it was called BlackBerry. They had the chat thing that they had.
BBM.
Yeah, BBM.
BlackBerry Messenger.
Absolutely. Thanks, Carl. What happened? All right. Because BBM thought if we held on to BBM, which was the first one to become popular, we'll be able to get more people to get onto the BlackBerry circuit, whilst WhatsApp opened it up to every different maker. And what happened? Well, not everybody wants to own a BlackBerry. You know, Carl want to own a BlackBerry, I want to own an iPhone. So if we're able to chat with our different phones that we prefer, that's how WhatsApp won that business. Now, could BlackBerry have anticipated? They took a choice. Unfortunately, it was a wrong choice. And that was more or less the end of BlackBerry. All right, and so it's really a difficult call for CEOs. And you really can't blame, you know, when the baton changes hands and say, well, you should have seen this or you should have anticipated this. I think it's a really, really difficult thing. And, you know, for those who get it right, fantastic. For those who don't, well, you know, it's like the way Nokia is trying to catch up. Now it's too late. It's gone. You know, and so yeah, that's life. Thank you, Sonny.
We will stay on this. I mean, it's very important. Dr. Raynor, you know, espouses the concept of strategy switching between a set of real options. And in my view, that presumes frictionless implications on. So I'm going to ask Carl, in reality, strategy switching or changing strategy is almost always costly in cash and in people. Do you think this is one reason for strategy hugging by CEOs, the concept by which they stay with a strategy even when it is failing? And indeed, how can you make this switch? I know, Carl, one of you had spoken earlier about embracing the home truth, just accepting the truth about us and then resolving it and moving on. So how do you deal with this cost issue in cash and in people when having to switch strategy, as we must at some points in our history managing the business?
I think to some extent, I have partially responded to that question in my previous session. Maybe it's an indication that I spoke for too long.
Yes.
But I always say strategy is a question of allocation of resources. But too often we think of the allocation of resources as where we go and spend money. And as often, maybe even more often, is where we stop spending money. So that's a very, very difficult decision for people to make, for leaders to make, to actually start killing a product line or killing a revenue line. For example, if I woke up today and I said, I want to make voice free on the MTN network, let us say, please, maybe I should delete that. It accounts for 50-something% of our revenue. The organization is going to freak out. And if I want to reprioritize the shift of my allocation of resources to other spaces, let us say now it is the content space as an example, to destroy something that's already created historically significant value and still creating value on an ongoing basis is very difficult. And you really need to be radical and have an extensive support of your investors, your board, and the organization to do that. The other thing I refer to is the ability to come to home truths and to accept that the way you're doing things is not the way that it's going to be going forward. And then you always need to question that, does the team, the CEO himself, have the ability to manage the new uncertainties, dynamism of the world going forward? So it's very difficult for organizations to actually shift strategy. Most organizations will tend to continue to hug their existing strategy and beat it to death until they're near bankrupt. It is a lot easier for smaller organizations to come to that reality because they are always facing existential threats, unlike large organizations that can just go along and I think, as Michael said, just take advantage of the normal GDP growth or normal industry growth and continue to generate enough cash. And it takes an incredible amount of courage to do so. I mean, one point I wanted to make, I think that was made, is that sometimes it's so easy to beat up on the mistakes of the likes of BlackBerry and Nokia and so on and so forth. It's not an excuse. We as leaders in business have to find a way of avoiding this pitfalls. But the honest truth is, I remember one of my early business school sessions where the poster child of how to do succession planning, talent management, strategy, everything was General Electric. And I don't need to tell you what has happened to General Electric today. Everything seems so clear in hindsight. Yeah. And it's a lot more difficult when you're in the driving seat and living in real time. And of course, in today's day and age where change is happening so rapidly. So we can only try our best and be judged at the end of our tenures. People congratulated me when I was appointed. I said, wait until I'm leaving and then you can tell me how well I've done and congratulate me. Thank you.
Thank you very much, Carl. I would stay with you. We all know and watch the evolution of the GSM business. Initially, it was predominantly voice. We have now seen a significant extension to mobile data, and then we are probably seeing, at least in this country, the onset of a movement into financial technology. How all of these, in my view, compels significant CapEx investment in equipment modernization, introduction of new technology. How does a big company like yours, a behemoth like the MTN, how do you look so clear ahead to make the call? I know you've spoken about this before in terms of resource allocation, and especially sometimes in very difficult operating environment like Nigeria.
So maybe let me tell a little bit of a story about the telecommunications industry on a global scale. 30, 40 years ago, the value was created by infrastructure. What you put down on the ground, fixed lines, the ducts, et cetera, et cetera. And a tremendous amount of value was created by by the infrastructural investments. And if you look at across the world, I don't know, the AT&Ts, British Telecom, Swisscom, whoever it might be. And that's why you drive through the city centers, commercial district, you see the biggest buildings. They've started to dispose of them. But 10, 15 years ago, the biggest buildings in every country, in every capital city was the big telcos, NTT, Docomo, et cetera, et cetera. That infrastructure was amortized over years, and then it allowed for aggressive competition, as well as a change in the competitive space. But if it hadn't been amortized, that change would probably not have happened. And the value creation has really gone much more towards the ability to manage customer relationships and providing the connectivity, which still rides on that infrastructure. Now, we in Nigeria are still rolling out a lot of that infrastructure. We've had to pump over the fixed network evolution and go straight to mobile, and things like 4G and 5G has helped us to do that. But connectivity in itself is going to become commoditized at some point in time or the other. Voice accounted probably 6, 7, 8 years ago for 90% of our revenue. By 2026 at the latest, I'm not saying that that's the date, data will be 50% and over. But even that is going to shift. And we have a slight advantage of looking ahead at what's happening in Eastern and Western economies, China, Europe, North America, etc., to see how it might evolve. And so the obvious responses are fintech, content, etc. But for me, I think we've almost missed the boat. If we can see it already in what is happening in the world today, we've probably missed the boat. And if you look at the intensity of activity in the fintech space in Nigeria, I think there's still a huge opportunity, particularly amongst the unbanked, but you must question if we're rushing into a space that there's so many people crowded into, it might be filled by the time you get there. And you have to start thinking forward as to what we can do to go beyond that. Obviously, we're in the information age where they say data is the new oil. And people are using a lot of data. Microfinance is one of those things. Hopefully, we'll start extending towards education and more SDG kind of stuff to really create value for companies. The problem with that, to answer your question, it was infrastructure, started with voice, now moved to data. We're now talking about fintech, content, and a few other verticals. But the use of data and data for automation, robotics, healthcare, etc., is going to probably drive some of the directions of future value generation in my industry, which is not restricted to telco, but also the adjacencies in the future. But I will say that so many people are jumping into data, and I'm going to borrow a phrase from my new CMO, Adia Showo, who said, there's tons of data, but very little wisdom. And that connects back to what I said earlier. Can you use whatever data that you have to confront the harsh realities and truths that are facing you? I've given a very broad response. I hope I've actually addressed the pointed question within that.
That's fine.
But exchange some ideas at least. Thank you.
That's fine. Thank you very much, Carl. Thank you. We have a number of questions that have come in through the Slido platform. Some directed to Dr. Raynor, and of course, I have sent one to Carl. So let me pose the ones for Dr. Raynor. How do we commit to success as a business and succeed or bypass the paradox? Can we succeed in business by bypassing the paradox that you spoke about? I don't know. You would have to answer that because you speak about uncertainty, and uncertainty is uncertainty. And in this world, there will always be uncertainty, but it's your question to answer. Your question is, from a strategic point of view, how do companies in Nigeria balance rising costs against the need to keep prices reasonable in a very price-sensitive market like ours? Have companies had to discount on quality to walk this tight rope, or do you think companies have to, discount on quality to walk this tight rope? Now, last question. When uncertainty suddenly shows up at the doorsteps, what do you advise CEOs leading businesses to do as they struggle to retain market share?
Wow. Okay, that's a lot to chew on. Let me take them perhaps almost in reverse order. So the last question, sort of when when lightning strikes, right? When a catastrophe shows up on your doorstep, completely unanticipated, I don't have a lot to say. I don't have a particularly informed opinion about how to cope with that kind of circumstance, right? So basically, the way I interpret what you've described is that essentially it's a crisis, right? There's something you haven't anticipated that is almost black swan type events. Mm-hmm. From Nassim Taleb's book of the same name. So when these unexpected and highly significant events arise, and I'm afraid I can offer not much more than do the best you can. I mean, yeah, that's an all. You've just run into the iceberg. Okay, run for the lifeboats because there's not much to say. That's not a phenomenon that I've spent a lot of time thinking about. There is, I'm sure, a well-developed literature for thinking about how to cope with crisis circumstances. And I will not embarrass myself by trying to rehearse a domain that I've not studied or have much experience with. So forgive me for ducking, but I'll hope that's seen as not a bug, but a feature.
This is in a price-sensitive market.
Yes. Okay. Sure. So price. I'm looking at Carl's observation. Never waste a good crisis. I think that's good advice. That sometimes can be an opportunity to shake loose ways of thinking that you've been trying to shake loose for a while, and it took a smack upside the head from outside the organization to make that possible. Price sensitivity is critical, and I'll come back to why I chose the Family Dollar example to illustrate the superiority of better before cheaper. And I'm recalling Mustafa's observation that affordable is a relative term, and he's absolutely right. Strategy is about your relative position compared to the relevant competition, right? And first order of business is that if you sell something nobody can afford to buy, well, that's not a particularly good strategy. I guess we're clear on that. And so the question is, relative to the market you are addressing, and relative to the competition that also is addressing that same market, what is your relative position? Are you competing on higher quality or are you competing on a lower price? And that, I submit, is always a relevant question, right? Because I've defined it that way. I've said, look, you've got a market that has a ceiling with respect to what it's able to pay, right? There'll be a range within that market. And given that you're in that market, what is your position within it, right? If you're above the ceiling, I guess you're not competing in that market anymore. You're either competing for the one above it, or you're just out of business. Nobody can afford what you're selling. So I submit that this relative position question is always relevant. And what the three rules suggest is, regardless of the segment you're competing in, what we found is that statistically, at least, odds are, competing for the higher end of that market is a path to, and this is important, superior profitability. If you want to have growth, well, then maybe you make a different choice, right? We didn't study growth. We studied profitability. And so that's a limit to the prescriptions that we have to offer.
Thank you. Thank you very much. Carl has a 2 cents watt contribution. He says, when it strikes, never waste a good crisis to make the changes you had been fearful to make before now. Time is certainly not on our side, so we should be rounding up, and I will be giving all my panelists an opportunity just to make their final comments. We will round up with Dr. Raynor, but let me ask Carl, Wale, and Sonny, in 60 seconds, no more each, just speak about what your takeaways are from the presentation of Dr. Raynor. I will start with Sonny and then go on to Wale, and Carl will then follow.
Well, thank you, Frank, and thanks, everyone. Yeah, for me, it's been a learning process, understanding a bit more about why companies obviously do make it and die, and why obviously you have new technology take over and new thinkings and so on and so forth. So it's been a good learning process. Not always do companies make the right decisions or CEOs make the right decisions. Like we said when it was clear that one of the things I would certainly take away from here is obviously the bigger a company becomes, and I think that's very intuitive anyway, the more difficult it is to actually change, the more difficult it is to actually change direction and to manage uncertainty, so to speak. And therefore, having companies that are maybe from a cultural perspective or even the way they're actually set up, more flexible in terms of their outlook, I think gives companies that stronger ability to actually be able to adapt to changing realities, especially like we said, in a very, very uncertain and difficult environment like Nigeria that we all operate. Thank you.
Thank you very much. Wale?
Yeah, so, well, what I'll just take away is that, of course, we'll have to embrace change one way or the other, advantage of opportunities, also take advantage of the different price segments that we find, our products. And at the end of the day, of course, deliver superior value to shareholders and, of course, superior value to our customers.
Thank you very much. Carl?
Well, here's another session where I realize how much I don't know and how much I need to learn more. But it does emphasize the imperative for change in my organization, as I'm sure in every organization. I think on the pricing, I think both Wale and spoke to the fact that there are challenges in an environment where you have decreasing disposable income, inflation, currency devaluation, etc. But I guess it behoves on us as supposed to find models where we can deliver superior. It doesn't have to be necessarily, Rolls-Royce world class, but superior quality and service to the competition within those economic constraints that we have to operate in. And then finally, just emphasizes in my mind, I think one of the slides, many of the slides that Michael has presented, that how did you call those super teams and the average Joes? I can't remember the right word.
Yeah,
super teams.
Yeah, it's clearly I should have more memorable labels. Miracle workers, long runners.
Miracle workers. That's it. That they don't just rely on cost, but through a superior product actually take a significantly higher share of the market or growth out of the market. So those are my takeaways. Thank you.
Thank you very much. Thank you. Dr. Raynor, let me ask you to just close this panel. Some of our panelists here run companies that are, either in their sectors or, close to leaders in their sectors. Is there a particular burden that CEOs leading such companies carry in a changing world that we are in?
I'm sorry, say again, a particular pattern?
Yes, I'm just saying that some of the CEOs on this panel lead companies that are leaders in their sectors. So I'm asking, is there a particular burden that they carry as CEOs leading such big organizations?
Yeah, I misunderstood. Sorry, burden. Yes. To be sure, I doubt I'll come up with anything that folks in this conversation haven't heard before. But the view I take and that I try to describe in the strategy paradox is that one way to, in some sense, lighten the load that CEOs necessarily carry. Right, everything lands on the CEO's desk eventually. I've never read a business book about a particular topic that doesn't say this has got to be a CEO level issue, no matter what it is, right? Everything is a CEO level issue, which kind of defeats the purpose of having a hierarchy and a well-developed management team, it seems to me. So to my way of thinking, the way to lighten that load is a division of labor and for CEOs to spend a disproportionate share of their time focused on the uncertainties the organizations face, focused on, as Carl put it, the allocation of resources and your follow-on observation, Carl, which I would endorse as strongly as possible as well, which is deciding what not to do. because pruning an organization, especially, I mean, small organizations, kind of, what's the point, right? When the tree's only this big, don't cut anything off. It needs everything. Larger trees actually benefit from healthy pruning, especially cutting off the dead wood. And the problem in large organizations is nobody ever thinks they're the dead wood. And that's, you know, when you say time to trim the dead wood, nobody puts up their hand and say, cut me. It doesn't happen, right? So having I'll say courage, maybe that's not the right word, but having the courage of your convictions perhaps is better, to say, look, here's what we're not going to do. Here is what we're committed to doing. And here are the options we're putting in place in order to position ourselves to cope with the changing world. You can't hedge every bet, right? You haven't got the money or the cognitive ability to that complexity, but you can hedge some of them. And so you make tough choices to position yourself, to protect yourself against some uncertainties and not others. Because the object of the exercise is not to live forever. The exercise is to increase the odds that you'll live another day. I'm getting a pilot's license, and there's an expression in piloting, which you may have heard, which is that takeoffs are optional, landings are mandatory. And no organization, I hate to break it to you, no organization lives forever. So that's not the objective. The objective, and no organization stays the same for as long as it survives. So the object of the exercise is to change as required and last as long as you can. And with that, I will close. Thank you.
Thank you very much. I hope the audience will join me in saying a big thank you to Dr. Raynor. Thank you to Sonny, Wale, and Carl for the wonderful time they have shared with us. We will be bringing this conversation to a close, but I had said earlier, and I assure you, if you are a BusinessDay subscriber, I can assure you that if you indicate interest, we will ensure that you get each of the books of Dr. Raynor after the conference. This is my own copy of The Strategy Paradox. I never let it go. That's our promise. If you indicate, we will to get copies of his book and that of Dr. Paul to you as well. I will at this point once again say thank you to the panelists and hand over to my colleague, Rolly. Thank you very much, and bye-bye.
Thank you, publisher. We will now take a brief message from our commercial partners. Afterwards, we'll be handing over to the moderator for the panel.
Delight was actually started to tell innovative, exciting, and positive food stories out of Lagos, Nigeria.
Being the foremost luxurious goods company in the entire West Africa is a big deal.
Will you have every opportunity? No. But you see, the opportunities you lose on
is the Director of People Africa, McKinsey and Company. I'll be handing over to Bolale now, but we will be taking a 7-minute presentation from the CEO of Eat and Go, Mr. Michael, before going into the conversation. Over to you, Bolale. Thank you.
Thank you, Rolly. Pat, would you like to take the 7 minutes presentation before we go on to our discussion?
Certainly. Thank you very much for having me. Just confirming that you can hear me.
Yes, we can.
Just confirming that you can hear me. Fantastic. Thank you very much for having me here today at the CEO Forum. It's a pleasure to be with you. I've been asked to speak today in relation to building a world-class fast food franchise area and the human resource element of our business. And I thought I'd start from the beginning of the conversation, is that if you want to have an excellent team and you want to have great customer service, you've got to start with really high standards. And that's one of the things that the team at Eat and Go are very dedicated to. We don't want to say that we're in a developing country so that standards should be lower. Standards should be as high as anywhere else in the world. So as soon as we have that as our foremost position, then we go about through our training programs. I think it's really important that that we hire extremely well. But when you're in a developing country, not everybody that you hire is going to have the same skill level as developed countries. So that's where your training team becomes a very integral part of your business. We spend a lot of time training our team. Our team will work in the field in our training centers for 2 to 3 weeks before they actually go into a store and start working with customers. And it's a really important part of what we do. We want to make sure that they understand our business and that they are capable of liaising and working with customers and making sure that they know our menu and can talk to customers and give them the best possible service. I think then it then gets into the store. And as part of any world-class business, the way you treat your team is the way your team will treat your customers. It's really important in our business that our culture is number one. So I've got a sign in my office. It's very simple. I don't care about your money. I don't care about your title. I don't care about your position. I only care about how you treat people. And that's something that goes through our entire company. It's very important that from myself to the person who cleans the bathrooms, to the person who mops the floor and cleans the windows, they're all part of our team and they're all an important part of our team. And there should be nobody in our business talking down at anybody in our business. We're all one team. We all work together. So culture is an incredibly important part of creating a world-class brand. In my view, in any country, and I've worked for Domino's for 32 years now, in any country, there's a very skilled workforce. And as long as you are hiring those who are motivated, those who have the ability to understand the training and be able to go into the stores and work with the team, and who are treated well. They're respected from the day they show up for their first training through to every shift that they show up at the store. They're part of the team. As I speak to you today, I'm out in stores and I'm visiting the team. I'm sitting in my car right now in between stores, and it's great to get out and visit the team. And that's part of my job, is that I'm the coach. I'm as much as the CEO as I am the coach. I'm out in the stores, talking with the team and letting them know, hey, I'm with you. I'm part of your team. So it's really important to be able to grow your business with your people. We have a policy in Eat and Go where we only promote from within. So as we hire people to the front line of the business, they have an opportunity to grow within our business. Our national operations manager for Cold Stone he started scooping ice cream with us in our very first shop and is now heading up our national operations across Nigeria. The same thing for our Domino's head of operations has come up through our stores. As we continue to grow, we promote from within and bring people through. And that's really an integral part, is that your team can see that there's a career opportunity for them as they come into your business. And it's one of the first things that I implemented as I came into Nigeria, is that, we've got to build careers for people as they come into our business. It's a developing country, and we're a developing business, and we need to be developing people through our business all the way through into the senior leadership and success of our business. So I think that's what I can share with you today in relation to building a world-class brand with the right team and the right motivation and the right culture. Culture is everything. I'm a firm believer in treat people the way you want to be treated, and your customers will be treated correctly if that's the right culture you've got in your business. Thank you very much, and moderator.
Thank you, Pat. We're going to hear more about that in our conversation today, but I think we can start off with introducing the panelists. We've already met Pat. He's the CEO of Eat and Go. I would like to introduce Dr. EJ Jidenma. She's the CEO of Leading Edge Consulting and managing partner of IRC Global Executive Search, a notable HR leader and a management consultant. We also have Rolake Rosuji. She's the CEO of Jobberman Nigeria, a leading recruiting platform. She has proven track record of business expansion and projects. And lastly, but not the least, Mr. Steve Shaw is the co-managing partner of Commercial Partner Limited, a member of the company's executive, and has nearly 20 years or over 20 years of business management experience. So thank you, panelists, this time. I know that we've all been waiting actively for this time where we're going to be talking about people. I like that Pat started off saying that he only cares about how we treat.
And I think this has been extremely positive, especially in cultures where FaceTime, especially in Nigeria, was really a big thing. You couldn't work unless your boss is looking at you and sitting next to you. But I think it's really a great evolution that now we understand that actually some people are even more productive at home. If you set them up right with the right tools that they need, they can do the job they have to do in a productive manner. So that's the first one about the future of work, moving into the tech age, even more so, leveraging digital technology to enable you to do work better and enable your employees to be more productive. The second one I'll say, and especially because, there's in a variety of sectors, there's no such thing as working at home. As Patrick was sharing with his organization, Eat and Go, it's very much an industry in food service where you need to be in the store serving customers, or at least as a dispatch rider, you need to be delivering. So the second trend I'll talk about when we speak about this buzzword of the future of work is really about where are the jobs going to. And what we can see from our data in Jobberman is that we've had an increase in companies in the banking and finance sector, telecoms and IT sector, and advertising and media. Actually, those sectors in Nigeria, they are looking for more people than they were before. So I mentioned that because businesses such as Patrick's, where you have to be face-to-face, they are looking for support from payments, from finance, from fintech. They're looking for support from advertising and media. And then there's a knock-on effect in the economy there. And then the last thing I'll talk about, the trend is people, because, we started there. And Bolanle, you've also referred to people. And I think what Patrick said about treating your employees, the way you treat your employees is how they're going to go out and treat your customers. It's so true. And I think often we forget that. And what we see right now with COVID, although there's high unemployment and people are looking for jobs, there's a funny effect now where Gen Zs and millennials, they also have a lot of power in choosing, especially those with very strong talent, in choosing where they work. So you have to treat people right or they won't stay within them. So those are the three things: technology and digital, treating people right, and then where are there actually jobs that people are looking for.
Thank you so much for that answer, Rolake, and for also summarizing it. So I'm going to go back to Pat, and I'm not picking on you, I promise, Pat. But I think the second question linked into some of the things Rolake had spoken about. How have you adapted your overall people and talent strategy to the accelerated changes of the past 18 months? Because nobody saw COVID happening until it came to our doorstep. So your industry has required people to stay in the shops, even though your customers were not able to come into the shops. So what have you done to adapt your overall people strategy to meet the demands of today's markets?
Thanks very much for that question. It's a good question. Funnily enough, as we were in the pandemic, about 65% of our business was still takeaway. People actually coming out and coming to the stores and picking up ice cream and picking up pizza and frozen yogurt. It was quite surprising, but you would expect that the delivery component really grew in our business substantially. So we had to hire in the middle of the pandemic when most people were letting go of staff. We were actually hiring. I think we hired about 200 to 300 delivery riders to continue to deliver more and more product out to the customer. We launched the Cold Stone website and the Pinkberry website so customers could order online, and we could deliver frozen yogurt and deliver the ice cream as well. We launched Cold Stone on Jumia. That allowed us to deliver through Jumia for ice cream as well. So we really had to change our ordering channels for the business. But from a staff perspective, all of our staff training, we've launched our learning platform. So all of our training now has gone digital. So our staff are doing training at store level. They can do it at home on their mobile phone. They can do it on a tablet or their computer. So all of our training is now, instead of being in our dedicated training centers, we do a lot of that decentralized now at store or at home. So our staff can pass their different classes and tests and so forth before they show up at the store to start work. So that was a quick change that we had to make. And then we had to introduce a lot of new policy and procedure around the way that staff, when they came into the shop, they had their temperatures taken, sanitizing, cleaning the dining room consistently. There was so much new policy and procedure that we introduced. So there was a lot of learning by the staff really quickly. But overall, the workplace is still the same. We were quite well prepared from a digital side of things to handle the changes that were thrown at us.
Thank you. Thank you so much for that. So we've looked a bit introspectively to what happened in the past. If we then pivot to what's going to happen in the future, EJ, I'm coming to you, right? Because you do recruiting, you do executive search. What are like the 3 top skills that you want employees or candidates to think about getting? And what are those skills that your clients are asking for? Even if they don't need it today, they are expecting the top talents of the future to have these skills. And what have you seen in the marketplace?
Yes, thank you very much. As you know, in this pandemic era, which is characterized by a lot of uncertainties, it comes with a lot of complexities in terms of the challenges that people face. So more than at any other time, people are faced with issues concerning their mental well-being, in grappling with all these changes that my colleagues have enumerated. So they struggle and seek ways of navigating through this new world that is emerging. So in that respect, one of the key skills, if I call it skills, are skills that are embedded in emotional intelligence, because you need that stability. And these are skills like listening skills, communication skills, things like being empathic. And being empathic means putting yourself in another person's position, which is something that in the past you could overlook, but now it's central. And clients would like to be sure that people you are bringing to them have that stability, because in emotional intelligence is inherent in emotional intelligence is able to even manage yourself, self-insight, to be able to deal with others And this pandemic came with a lot of, challenges, like people working from home, which is not what they were used to. So you need to really sort out all that. Again, another thing that readily comes to mind is agility. Because of the changes, to be able to navigate from what we used to know to another thing, just like they were talking about switching strategies. You need people with those kinds of capabilities, people who can easily move. I mean, when the parameters change, you may have set up to your strategies, but in no time, the assumptions on which those strategies were set could easily have changed. So you need people that are agile in terms of their mindset, people who are flexible and adaptable. These are all, skills that go together in terms of looking at agility. People who are able to now change as things change, not those sort of like managers that are already programmed to do things in a definite and defined way, but leaders that are able to immediately adapt and change as the situation demands. Then the third thing, which I can say that increasingly is being taken for granted, I don't know whether to call it the third, but it's something that people are taking for granted, is the digital skills, because in today's world, it's like a given that you have to be able to operate in a digital environment. There have been situations where, people are recruited and then they're not able to do that at all levels. Before, you thought that the digital skills is just for IT people, but no, the environment, you have to have that this technology savvy. And he said that the illiterate of the 21st century are those who cannot unlearn, learn and relearn. So all these are required. And we have generations in the workplace now. We have the generations Z, we have the millennials, we have older people and so on. So we should be able to, so clients are not looking at people to come and train, or people you would already generally have those kind of skills. So if I say that this is taken for granted, then I would now say that my third one is integrity, being authentic and being able to do what you said you would do. And this authenticity also, comes with dependability and trust. Because, you need that kind of level of trust as things are so uncertain. But if you're working with people that you trust, then you'll be able to at least have that peace of mind, if I may put it that way. So this is the kind of people, skills that clients today are looking at in terms of hiring. Thanks.
Thank you so much. So I'm going to pour it all on you, Steve. And I promise I'm not meaning to be a terrible person, but she said many things. And as the managing partner of an organization, I want to tackle some of the things she said. She says to me, CEOs expect their employees to have these skills. Is this true? Are you expecting your employees to already have the digital skills that you did not train them to have? That's one. She says to me that you want people who are agile. How are you training and preparing your workforce for the agility that you expect of them in the next 12 months? We are having a conversation. So I want to hear from you, not from what you do with your clients now, but as an organization and the CEO of a leading organization. How are you preparing your workforce for some of these skills that some organizations seems to be expecting their employees to have already without training them for it?
Thank you so much for having me on this show. I think the question you passed to me is actually some of the questions have been answered by the previous speakers. and some of my panelists. But as organization, at Commercial Partners, we are quite big when it comes to knowledge and product innovation. I think is one of our core driver at Commercial Partners. And the way we balance this is how do we get our staff to have that knowledge base without, how do they create the products? How do they have that creation or innovation without having, the knowledge base that is required? So we are actually quite big on that. And one of the ways to actually make sure that we train and ensure that we build the next generation of leaders at Commercial Partners is to actually create what we call an academy. So we build an academy called a CP Academy. We have different faculties where we train people about the soft skill, and we just don't train about the soft skill alone. We train them about the leadership qualities and leadership skill and what is required for them actually to be the next leader of tomorrow. And outside that, I'm actually a very big advocate of, own your desk. So in organization like my previous speakers have actually touched on, we have different generations of staff. Within the organization, you have the boomers, who we try to prepare, or we try as much as possible to allow the boomers to prepare the successor, at this point, going to the future. And that helps in some ways because it helps in the continuity of the tasks associated with the position that actually been handled, and it prepares the next generation of leader to take that opportunity to the next level when the more experienced people in that desk probably retire or resign or move on in their own career. I think another area we actually try as much as possible is just to acclimate all our employees to mentorship and on-demand training programs. So we try as much as possible to mentor them on the job, to mentor them in different ways, whether outside the job or on the job, and to create a lot of training programs for them to be able to learn the basic skill and what is required, because we operate in an environment that is actually very, very volatile. Being in the financial service sector, it's quite volatile, and you need to prepare your next generation of leaders in how to take decisions and how to actually navigate that particular terrain. I think if you look at it in the way the sector where we operate is right now, and for you to actually build a gap between our millennials, the Gen X or Gen Z category of staff, then another area we look at categorically and passionately in Commercial Partner is we hire executives to coach some of our key players or some of our senior staff. The reason is because most time you don't have the resources in-house, or you don't have the time to be able to train some of these people. So what we do is just to bring in people to coach them on leadership skill and qualities. And you all agree with me that most time you have situation where, or we agree that, most professional leaders always have their blind spots, So when you have these experienced coaches and they actually throw them, on the job to actually learn on the job and face challenges at work, it allows them to be able to get a lot of knowledge and be able to identify those blind spots that they have. And at the same time, sharpen the skill to be able to recognize those blind spots and improve on it and build on the success. So it's a very critical area that we look at Commercial Partners. And as a leader, again, we have something that we call PDP. PDP is not it's not People Democratic Party like in politics, but we call it, personal development program, where we actually sit with different staffs and leaders within the organization and actually talk to them about basic skill that they need to earn to take them to the next level and enhance the skill. And we look at the gap area where we think we need to fill it. We need to fill those gaps, and we discuss with them on those areas through the line manager or direct interactions with the CEO so that they can take it to the next level. Another thing we look at critically from our side is to look at what we call emotional intelligence. I think the last speaker actually touched on that. The emotional intelligence is actually very important because we think and we believe so much that it actually could be a descriptor to the success that the leaders will actually birth going forward, because he at times actually can distinguish between just the technical skill and the IQ. So we take so much, we take cognizance of that, and we make sure we do a 360-degree assessment for some of our leaders to be able to see how they adapt to this emotional intelligence skill. I think those are the few issues that I can remember now to cover up.
No, thank you. You mentioned, you thought that they had said everything, but you actually mentioned a few things that they had not touched on. And I'll come back to some of those things later. Rolake, I want to ask you, it seems like most organizations are converging in terms of the characteristics of the future leader. How do you advise organizations to stay unique to their culture while still building this broad set of skills that everyone is saying would be required?
Thank you, Bolanle. Yes, I think the buzzword for today's session is emotional intelligence and being self-aware. So I'll share very quickly for those listening who may be thinking, yes, I understand that that's necessary in my organization, and we don't yet know how to build up that emotional intelligence. You can find the soft skills training on Jobberman's website, which is focused on emotional intelligence and soft skills. So please check that out if you're interested. So regarding your question, Bolanle, how can leaders stay unique to their own culture, where we see that right now with COVID, there's a general trend towards a requirement for digital skills, emotional intelligence, managing teams. So how do you stay unique to your own distinct culture? I think this is a really important question, and one that each leader needs to self-reflect. If you're in a position as CEO or in a position as HR director, you need to really dig deep and understand what is the value proposition of your organization. As Eat and Go, what really makes Eat and Go special? What makes it unique? So I think first of all, the first bit of work is to really understand your own culture and what makes your culture good, and then be self-aware enough to understand what makes your culture perhaps not so good. And then how do you stay unique to that in this world of very competitive talent, millennials and Gen Z demanding so many benefits? I think it's really down to authenticity. It's really down to you as the leader and your management team really owning your own uniqueness and being open with that with your team, showing vulnerability at times, showing when there's things you don't understand. When Steve was speaking about teams and being a leader, what came to my mind was, often as a leader, what you needed to do is actually to hire a lot of people who know a lot more than you. And you need to be confident in the fact that you're building a team who have skills that you may not have yourself. So coming back to overall culture, it's you as your management team owning your own unique set of characteristics that makes your organization special, and just being confident in that, doing very clear onboardings and trainings when each new person comes on board about what makes the organization unique, and having regular town hall meetings. Some organizations like to have these town halls as often as once a month, where everybody in the organization can ask questions and it's real time. You don't have time as a leader to prepare too much. You just have to be honest and direct. So I think sessions where you can really be open, you have town halls, you do very clear onboardings, and you as a leader, you also share your own experiences and you encourage your management team to share their own experiences, both the good and the achievements, but also the challenges. That's how you build the culture, when you show people through your own experiences.
Talk about how you grow the talent within the organization. Which means that if I'm going to be the next CEO, I should have joined Eat and Go 25 years ago, pretty much. But even within that, right, you have thousands of employees in Eat and Go. How do you then identify that final 10 people that would be the management team of the future? How do you go through that process of deciding who those people would be?
Thank you very much for the question. The ones who continue to move up in our business are the ones who are the high performers. So everybody has an equal opportunity to grow within our business, but the ones who are achieving the best results within the business are the ones that generally grow in the business. So we are always on the lookout for people to move forward, and a lot of that is with expansion in our business. So the more that we expand the company, the more opportunities that open up. Those opportunities are filled by people who have been achieving ahead of budget results, people who have won awards within the company. And that's open to everybody. Everybody has the same little playing field to achieve those results. They all receive the same training. They all have the exact same, for lack of, I'm repeating myself, the same playing field. So really those who work the hardest get the opportunities to grow within the company. The good thing about Eat and Go is that we're continuously expanding. So, as we speak here today, I've got 20 stores under construction. So that's 20 new managers that are going to be promoted from assistant restaurant managers and who probably started as customer service representatives in our team. We've just filled the 3 regional manager roles across Nigeria. And those are people who've been promoted from district managers up into regional managers. As you said, the next CEO, I won't be the CEO forever. And will be another CEO, and that's something that upskill, a continual recruitment and a continual growth of your team as you are growing your business. I've just finished my board meetings over the last 2 days, and we went through the company organogram, and I explained what the organogram looks like for the next 4 years. And the one thing I said at the end, and this is the organogram as we see it for the next 3 years, but rest assured this will change.
No, Pat, I think your network bandwidth is a bit low, so we can't hear you anymore.
Get together and have a discussion about it. So you're never.
Yeah, it looks like we've lost Pat for a minute there, but I want to ask one last round of questions before we go. Rolake, to you quickly before you go. Can you hear me? So we've been told that artificial intelligence is going to take over the world. Of course, for the regular 9-to-5 person, we are all in fear of what that is going to mean to us. So what is going to help me keep my job as a human versus losing it to an AI?
Thank you. Yeah, very relevant question. I mean, funny enough, not everything, but a lot of what we touched on earlier was about people skills and emotional skills, managing teams, coaching. So artificial intelligence will not entirely take over the world. You will definitely still need to have your people skills. I want to share to people in the job market that you can go on to jobwoman.com/research and you can download our reports on trends in the job market in Nigeria. And yes, artificial intelligence, data science, software developer, a lot of tech skills. There's a growing trend in Nigeria, and we've had issues actually filling those jobs on our websites in Nigeria. And interestingly enough, we know that we have that talent in Nigeria because I know of many people who are living in Nigeria and providing those sorts of jobs remotely from here. So how do you keep your job in the future? Keep training on the hard skills that you require. You can download the report on jobwoman.com of what hard skills are in need, both in tech, but also in business development, in sales and marketing, so many of them. But also make sure you maintain people skills, how you relate to people, both peers, those reporting to you, and also your bosses, and importantly, your customers and clients.
Thank you. Thank you so much for that. Steve, I want to ask you, personally now, so we are taking off your CEO hat and asking, what are you doing in your personal life to prepare the future leaders of Nigeria? And I'm not trying to put you on the spot.
Thank you so much. I think on my side, one thing that is critical for me is empowering young minds, and it's one of our strategic intents as a company. So personally, I try as much as possible to mentor people. I sit on 1 or 2 companies on the director's capacity, and at the same time non-exec. So try as much as possible to see how much value I can bring on board to any organization that actually sits at the same time to actually train and coach the next generation of leaders in terms of how to lead. And I think one thing that's actually very important from the days that when we're coming from, when we actually started our career, was that we have a different mindset in terms of how we approach the business and the work. In fact, before we actually before we knew that we were going to become, leaders of businesses, years back. So I think that gap in terms of applications to work and how you actually look at the contributions to the bottom line and to the business and how to grow the business first, beyond just looking at the material and the financial gain. I think it's very key. I think that is lacking these days. We have a lot of young Z and young X who are looking for quick money. So we try as much as possible to actually, organize seminars, coach them and tutor them on how to apply themselves to business and to work, create values, add value to the business, grow your knowledge base, and at the same time, expand your vision beyond just, sitting in just one cocoon of a business. I think that's basically how I'm trying to contribute to the next generation of leaders from my own part.
Thank you. And EJ, what would be your advice to CEOs that are listening today in terms of retaining their high performers, right? Because the last thing you want is to put in all of these efforts that the different CEOs have spoken about, and then because of the great resignation that is happening around the world, you then end up losing people you've put in so much effort into. So what's your advice to CEOs about retaining their future leaders?
Yes, there's the great resignation all over the world. Because that, like I said, the pandemic has changed so many things. So people are even beginning to wonder, am I really in the right kind of job? And what is best for me? Am I supposed to be in the 9 to 5 employment beat, or should I be an entrepreneur? And all these sort of questions. The great resignation has not been too much or too significant in our country, Nigeria. We've been a bit lucky, even though there have been other things in the environment that have really, really affected us even more. Things like security, insurgency, and so on. So you see professionals living for places like Canada, professionals in accounting, professionals in medicine, and all that. For retention, generally, given all these, the main thing is for organizations to try as much as possible to create sense of purpose for their employees, because that is what would keep them, not necessarily the pay package. That sense of purpose, which may be lacking, is very, very important. And also to retain these employees, we should know that things are also changing. People are beginning to have better self-insight in terms of what they really want, what their purpose in life is. And the younger ones, they have it well defined for themselves. They're not going to organizations thinking that they will stay their whole lifetime. So employees, so that creates a challenge for employers to do much more than just the pay package in terms of creating sense of belonging, because when people have that sense of belonging, they will go the extra mile. And also increasing the younger people, they want to see that the environment is conducive for them. I know that today, right now, we work remotely, we work at the office and so on, but these are some of the things that contribute to that. I know a situation where a candidate or the newly hired candidate resigned simply because of the environmental factors and simply because of some of these new challenges that things like COVID has brought to us. In fact, some people, after testing the opportunity of working from home, the opportunity of flexibility, are no longer ready to go back to those regime of very highly stereotyped regime. right now. So flexibility is key. The important thing is that someone delivers. There should be more room given to employees, because people are unique in themselves in terms of what they want. So that freedom is very important. Freedom with responsibility, I would call it. And that places challenge in terms of clearly specifying the expectations in terms of KPIs, not necessarily in terms of being there physically or what time to be there and so on. But, making sure that people have that sense of self, being themselves. So those are some of the things that would help in retention. And, no hostility, so that even when people leave, there will be great ambassadors of the organization. And understanding that people have their own personal drives and dreams that they're also pursuing, and to make sure that that is recognized in leadership. Thank you.
No, thank you very much. And I think that's the perfect segue into our final remarks to the people listening, whether they are CEOs or future leaders. Steve, I'll start off with you. What would be your final remarks to close off this conversation?
Thank you, Bolanle. I think from me, one thing that I'm going to say is that there's no substitute for knowledge and for hard work. So for me, I think is one of the key factors that I think the future leaders should look at. We've touched on a lot of issues around emotional intelligence and some other few issues, but I think in terms of knowledge, because whatever you find yourself, you're going to be called to task, and you have to deliver the task. So there's KPI for you, and the company is going to measure you based on that performance. So there's no substitute for knowledge and for hard work. That's one thing that I want to pass across. And at the same time, I think communication is very important. Most of the people these days, leaders don't really communicate effectively to their subject. I think it's very important that we actually have that line of communication, which is, you have to have that, lead with optimism, and empathy, and making open communication a priority to the next generation of leader. And, we've touched on empathy. As a leader, we have to be empathetic, because there are times in your life, during your career, that you're going to wear shoes of the team members, at any point in time. So you need to, be empathetic to whatever they do within that team unit. I think those are the few things that we can think about now in terms of my advice. Thank you.
Thank you. And you, Pat, what would be your final remarks? Looks like I've lost Pat.
Can you hear me now?
Yes, we can hear you. Thank you.
Hello. Okay, good. My final remarks are very similar to that when I came into the conversation, is that for leaders of industry, it's important that people are treated properly. They're motivated through proper culture in their company. I'm a big fan of treating people the way you want to be treated. For the people who are coming through in the business, COVID is a moment in time. I'm a firm believer of having our office open, having our people working together, working on projects together. Our office is open now, we'll continue to be open, and we'll push forward. I guess we're a little bit back to the future in that teams working together get things done. And there's great opportunity. COVID will come and go, and the world will get back to where it was, and we will work and enjoy working together and socializing together.
Thank you. Thank you so much. EJ?
My final words for executives in Nigeria is to, to yourself be true. I mean, in terms of having confidence in dealing with whatever is there for you. While there are universals, everything should be taken within the context Everything should be situational. You should be able to analyze where you are in terms of the stage in your organizational cycle. You should be able to determine where you are in terms of the culture you want to espouse. You should be able to, you cannot cut and paste. You should know what you are driving for. That would be my word. And so that, because what works for another person may not work for you. You have to be focused in terms of what you want to achieve and deliberately and decidedly move towards that. Thank you.
Thank you so much. Thank you for the discussion. I've written down a whole page of insights from the conversation. I've heard a lot about mentoring. I heard about executive coaching for our leaders or future leaders. I heard about personal development. I heard about being true and kind to one another and to our employees. I've heard about open communication to authenticity. I heard about being high performers. I think my quote for the day is from Mr. Steve Osho, who says, "There is no substitute for knowledge and hard work." And I think whether you're a current leader or a future leader, that's a quote that we should all take away. Thank you so much for your time. I would hand over now to Dr. Ogo Okiti to take on the last segment for the day. Thank you.
Thank you so very much. Thank you so very much, Bolanle, and thank you for moderating that last session. Very, very insightful. And I am particularly delighted that we ended this conference talking about people and, of course, the future, because the people are the future, especially the young ones. I'm delighted that we were talking about skills, because wherever it is about strategy, innovation, and wherever it is, we will always rely on people. Also on the panel, I want to thank you all, Patrick Mike Michael of Eat and Go, Steve Osho Commercial Partners, Rolakes Rosiji, Jobberman, and of course, EJ Jidena. I want to thank you all for the insights that you shared in the last session. So on the conference as a whole, I have thoroughly enjoyed this 13th annual Business Day CEO Forum. And it has come to an end now, and I thoroughly enjoyed it. I enjoyed it because the discussion have been broad, but detailed perspectives have been shared today. And I sincerely hope that all of you that joined us and from wherever it is that you did, that you found the insights shared that will help you and your organization regain the strategic flexibility, which is the entire hope of the conference this year. From my own point of view, I think a key aspect of this, which was not explicitly mentioned, but obviously shared in some other ways, is that companies and organizations will have to continue to respond to data, both direct and of course indications of the data that actually affect their businesses. If we don't continue to respond to those data, our strategy and of course will fail, and of course our uncertainty will widen. So I really do hope that businesses going forward will continue to respond to data. And I think it was someone that was sharing some insights around data, I think in the previous session, that sometimes you have too much data, but which one is really, really useful is very, very important. Let me now use this opportunity to thank our two keynote speakers. Dr. Jean Michael Paul, who is the founder and CEO of Acheron Capital, a very insightful presentation that kicked off this session today. I mean, talking about how we have failed, and of course, how we have to quickly retrace ourselves in the area of capital, and of course, looking into the future. And of course, I want to also thank Dr. Michael Raynor, shared insight in his 3 books around strategy, innovation, and of course, uncertainty. I thank them both. And of course, all our panelists on the first and the second session, which some of them I believe would have dropped off by now, but I really, really thank you all for your insights, and for the ideas that you have shared at this conference today. I know that it's very easy for me to say this, but this is one of our best CEO conferences in recent times. I really gained a lot, and I really hope that those of you watching from wherever it is that you're watching, that you also gained a lot of insights here today. Let me now end my thank you and closing remarks by thanking our 4 formidable sponsors. We always say in Business Day that it is important that we have ideas, but for us to be able to execute those ideas, we need partners. There is nothing we do in Business Day without partners. So I really want to say so much thanks to MasterCard, who is our flagship sponsor, and of course, MTN, our co-sponsors, and our great value sponsors, commercial partners, and Eat and Go. I thank you all for your time, and I thank you for the insights, and I look forward to seeing you again on our other conferences, and most especially when we gather again for the 14th Annual Business Day CEO Forum. I look forward to seeing you all. Please have a great Business Day afternoon. Thank you all, and God bless you. Bye-bye.
Delight was actually started to tell innovative, exciting, and positive food stories out of Lagos, Nigeria.
Being the foremost luxurious goods company in the entire West Africa is a big deal.
Will you have every opportunity? No. But you see, the opportunities you lose on account of your value system, that's your opportunity cost for what you believe, and is the price you must be willing to pay.